record. Good evening, everyone. Welcome to our monthly IBD Meetup monthly overview. My name is Roy Maddox. Wes and I are the host and facilitators of this monthly meetup. It's sponsored by Investors Business Daily. We're one of the largest meetup groups in the country with almost 2,000 members and attendees that join us regularly. And so we wanted to thank you for joining us tonight. I'm also the Chief Market Strategist and Portfolio Manager of Integrated Financial Strategies here in Charlotte. And just to give you a little bit about my background, I've been employing CAN-SLIM techniques and tactics for 35 years over many different market cycles. This is just another one of those vicious bear markets that we've experienced, that we experience about every 5 years. If you're not on our email list and would like to receive some of our comments, please respond in the chat menu and provide your email information, and Wes will add you to the email list. We're a private group of stock aficionados. We love the market. We love what the market has been able to provide us in terms of securing our financial future and our financial destiny. And we believe that all that is possible for anyone with persistence, dedication, resilience, and passion for the stock market. Many of us that are on this call have great experience. And so tonight, I hope that you pay attention and learn from some of those fellas that have been around for 30, 40 years in trading the markets. All of us tonight are here to educate each other and connect each other in this active, vibrant community that we're all involved in. We focus on combining technical and fundamental analysis, and we base most of that on the concepts that are found in William O'Neill's book, How to Make Money in Stocks. I met Bill O'Neill at a seminar in 1988 with his protege, David Ryan, and it really changed my life. It cemented and motivated me, and it inspired me to embark on this lifelong journey. And I hope that we can do that for you tonight as well. Most of the discussion tonight will be related to concepts found on investors.com, the website. And that's where we find many of our resource tools. And we'll be utilizing tools from Investors Business Daily tonight, such as Market Smith. Tonight's agenda will be divided into two different sections, two different portions. In the first few minutes, I'll provide an overview, and then Wesley will take you through a slide deck that we typically do on a monthly basis to assess the market condition and to assess the market strength or the lack of strength. And I think that you'll find it very interesting. Then the second half of the program will be focused on individual stocks. So we'll probably go through 100 stocks tonight, trying to identify the next leading stocks in the market and the true market leaders. If you're new to this, don't fret. Many of us were novice investors at one time. And, I was a novice investor myself in 1988. It just shows you with the right mindset that anything is possible. Remember, this is America. Capitalism and innovation prevails, and anything is possible. So if you apply yourself and want it bad enough, just go for it. And let me pull up. Get this right. This is a little bit about our community. You can find us, you can Google us at Charlotte Investors Business Daily Meetup Group to join the community if you're not a member of the community. There's also some information there that you might find useful in terms of books to read and research opportunities and so forth. Of course, this is our disclaimer. The information tonight, it's not to provide specific investment advice. It's for educational purposes only. We won't spend a lot of time on CanSlim. We used to spend quite a bit of time on CanSlim, but for the sake of time, we just have the acronym posted here. And this acronym has been, of course, it's famous from Bill Neal's book, and it's led to many great growth strategies over the last 30 years. And we think that it's a very viable strategy and process. Just to give you an overview, we believe that there are three stools of a proper investment strategy. The first consists of technical analysis, and we'll talk a little bit about that. And then fundamental analysis is taking a look at the financial condition of the firm, looking at financial ratios, considering earnings per share, debt loads, growth rates, and so forth. And we also believe that macroeconomic analysis is important as well, because it helps you identify where we are in the economic cycle. And tonight we're going to discuss where we are in the economic cycle. And we believe that the economic cycle is going to show slower growth and lower interest rates. And we believe that that's in this deflationary environment, it's going to create a profit recession probably in the first quarter of next year, which is problematic in the stock market from a valuation perspective. And we'll talk a little bit about that. So these are the technical analysis bullet points that we typically focus on. We pay attention to the MACD primarily. That's the moving average convergence divergence indicator, which measures momentum and momentum in the market. We're actually on a sell signal on the MACD in the NASDAQ, the S&P, and the Dow right now, even though the market rallied today. We look at things like price phase, stochastics. It's important to look at rate of change. Rate of change in the indicators is important. Rate of change in relative strength. And the SKSD indicator is one of our favorite indicators that measures intermediate term momentum in the market. And that's a derivation from George Lane's stochastics formula. So the most important thing, however, is the trend of the market. And you might have heard the adage, and we've all heard the adage probably, of don't fight the trend, don't fight the Fed, and don't fight the trend in the market. Currently, the market is in a confirmed short-term and intermediate-term uptrend. It's a struggling and indecisive uptrend that's not providing us many opportunities or for many individual stocks that are breaking out to new highs. So it is a fledgling uptrend currently. And whether or not we turn down at this 200-day moving average remains to be seen, but we'll probably have a good idea in the next few days of whether or not we roll over and recheck the lows, or possibly even go through the lows, or if we'll resume the uptrend and take out the 200-day and stay there. The intermediate term, as we define it, is the 21-day EMA greater than the 50-day EMA. And we see that currently is a flashing green. And the long-term moving average, we look at the 30-week moving average. The NASDAQ is under the 30-week moving average, but the Dow, which has been the leading index, is currently above the 30-week, and the S&P is above the 30-week moving average also. We look at things like breadth. It's important to know well, how are the general stocks doing? Not just the indexes, because many times the indexes or they might not do anything, and so your true asymmetric growth in your portfolio, it's going to come from individual stocks, and that's why we focus most of the time on individual stocks, trying to find the stocks in a market cycle that can go up 2 to 3-fold over 8 quarters in a in a nice uptrending bull market. That's what we're looking for. We also look at the current the percentage of stocks above these moving averages. The 50-day will show you the short-term breadth. How healthy is the short-term breadth of the market? When you look at the 200-day, you can see whether or not the market is very strong or not. And Wes will take you through some of these tables that show you that the market is stronger on a short-term basis, but still we have many bearish signals when you're looking at long-term numbers. The advanced decline line is important, as well as the new highs, new lows. It is almost impossible to make money in a market when new highs don't exceed new lows. And you need a sustained period of advance for that to happen as well. And we clearly do not have that right now. In fact, we had, again, more new lows than new highs today. And the new low list has been actually accelerating over the past week. Sentiment is judged by, you can judge sentiment using technical indicators such as the VIX and the put-call ratio and the amount of exposure that individual money managers are invested in the market. That tells you something. The index option adjusted spread will also show you the general health of the bond market and the credit markets. That's important as well. And then you can gain some information from looking at ratios. Are stocks doing better than treasuries? Or defensive stocks doing better than aggressive stocks? Or growth stocks doing better than value stocks? What about factor exposure such as small caps versus large cap? That's important to look at as well. So this is, by the way, we will send out this slide deck to everyone that's on the call and that's signed up. So feel free to share it with your friends, of course, or your colleagues. And we think that it will provide you some great input and research so that you can conduct your own research in the future. So have at that and enjoy that. The fundamental analysis, a component of constructing an investment portfolio, it's right here. It's the great true market leaders typically come from stocks that are growing their earnings, and their earnings are accelerating. Bill O'Neill found that the greatest stock market winners many times had 3 quarters of accelerating revenue growth and earnings growth for many true market leaders in the past. So that's important to look at. And in the market environment that we're in currently, you're going to be able to pick out these true market leaders, and we're trying to pick these true market leaders out right now. And these are going to be the stocks not making and bouncing from 52-week lows, but these are going to be the stocks that are within 15% of their 52-week high, that typically have an earnings per share rank of 85 and a relative strength rank of 85 or higher. So now, when you're coming off of a bear market bottom, you want to identify and try to find the next Zoom, the next Tesla, the next Apple, the next Google. And these are stocks that are going to have a moat around their business. They're going to be ubiquitous and widespread. They're going to have tremendous markets in terms of the market size and market potential. But more importantly, they will be making new price highs. So your new price high list, stocks that are making 52-week highs, that should be your primary buy list. This is where you'll find the leaders, and you want to concentrate in the top performing industry groups. That's very important. IBD has ranked, they've ranked all the industry groups. There are 197 industry groups, and they've ranked them from 1 to 197. In a rip snoring bull market, you want to concentrate on really the first 4 to 5 the leading groups. They typically get there and they stay there. But if they're not in the 1 through 5 group, look for groups, look for the top 40. Rarely do I ever screen and buy stocks that aren't in the top 40 industry groups. That's where your leaders come from. And finally, on the last component of CanSlim is the market direction. Just like today, and just like what's been going on as we've been in this long-term bear market correction, most stocks are breaking out and failing. So either when that happens, the environment is not right, or either the stock's not right. And really, that's the kind of activity that we've been experiencing really all year. And this is, I'm often asked, well, man, when is this going to end? You have no idea when it's going to end. But if you're watching the market and you're watching the new high list and you see an expansion in new highs, and the environment's going to improve, and you're going to be able to get some traction in your trades. And we don't have that currently, but it is coming. So don't be dismayed. It will turn. It will come. The market will finally bottom, and then we'll have some great upside. And the macroeconomic analysis that we rely on is provided by Keith McCullough of Hedgeye, and he's got a proprietary nowcast model where he's looking and predicting the rate of growth, what the inflation outlook is, so that he can get ahead of what the Fed policy is going to be. And his model currently right now shows that we're in a quad 4 market where growth is slowing. And we are in a period right now where you're hearing every single day, every single economic statistic, it's talking about inflation. And what's going to happen in the next probably 30 days is you're going to have a departure from that. You're going to move from inflation, because inflation clearly has topped, and we're going to move to recession talks. And we'll look at some slides tonight. So, that is very important, because Wall Street wants you to believe that lower interest rates are good for stocks. Well, not necessarily going into a global recession that we're currently in. When inflation drops, prices drops, that puts pressure on profit margins. Then the companies have to lay off people, and then when they lay off people, Wall Street's got to reduce their numbers, and it becomes a valuation concern. And we believe, Wes and I believe, that the market is overestimating what earnings are going to be next year. And all the market and all stocks, there's a high correlation over time that the price of the stock rises based on its earnings growth rate. And when the earnings growth rate is slowing down, it doesn't make growth stocks attractive at all at the beginning of a recessionary environment. Great information from Hedgeye to alert you and to inform you that there's typically, where we are in the economic cycle, various sectors do better. And we think that we're in a period where interest rates are going to drop in the 10-year and the 30-year as well, as interest rates drop. And so that really makes bonds much more attractive than stocks going into a recession. So that's important to look at. Typically, long duration bonds are your best performing asset classes in a recession. So in the beginning of the recession, and the National Bureau of Economic Research, they don't believe that we're in a recession yet. But if we're not in a recession yet, it's coming because the yield curve is demonstrating and showing that to us. And with that, let me turn it over to Wes. And Wes, take us through the rest of the slide deck, please.
Okay, so if you could stop share.
Okay.
All right. Okay. So here we are. All right. So thanks, for the intro. Everyone, we're glad to see you all here for the last meeting of our year. If you made it through the whole year with us at all these meetings, congratulations. It's been a tough year. So with that, I'll just keep going and we'll start talking about this, more details about this bear market. And we kind of always lead off with, kind of context amidst this bear market versus others. This is a good visualization, and this is from I really recreated from Ciabaco Capital, and just giving us some goalposts of average recessions. We're this green line highlighting here the average bear market with no recession, so minus 29% for the S&P 500, and this is looking at like the last 90 years, I believe, from 1929 and on. So that's no recession. We never even hit that. A typical or an average bear market, including recessions and no recessions, is minus 36%. This black line, and an average bear market, including a recession, being minus 42%. So, I guess right now we're leaning towards a recession, right? We've talked about that, and that's partly because of the macro research that we consult with. And so, if that is the case, it's possible we're starting that, what do we say, 1, 2, 3, been waiting for a third leg and waiting for, panic, and maybe we'll actually start to get that soon. But and for all those reasons, we'll talk about why we are kind of bearish, although we do have a little bit of exposure right now. And this is just another look at past earnings recessions, just showing the magnitude of earnings declines that we see when earnings do decline for the S&P. And notice that it lasts about 10 months. The average decline in EPS being about 30%. But if you exclude those really massive lengths of earnings declines, being 2000 and 2008, it's just a 19% decline on average. But significant. And this is what we're up against. This is what we have to consider. I don't recall exactly the S&P Wall Street estimates for earnings, but I believe they're either flattish or maybe even up a little bit for next year. And what, Roy, do you remember that?
Yeah, that number's 5%, and that's where Wall Street is. But remember that the estimates, they're expected the S&P earnings to be at $230 for the year. But we think that if there's a recession, and again, we haven't had this earnings decline, we expect the earnings decline to come this next quarter based on the slowdown. And we think that we could be at $195 to $200. I mean, typically in a recession, you can see earnings drop 10, 15, 20% or more. And we think that Wall Street is overestimating how this is going to play out.
Yep. And I remember we were talking about one particular company today, and I remember seeing those earnings for, the last 7 years were like $5 a share, no real growth. And then just within the last year, we're at $15 a share. And it just seems kind of ridiculous to assume that we're going to stay at that level. Some old established retail company that's not really growing footprint, right? They didn't triple their footprint. So something unsustainable clearly has happened in a lot of those retail companies, just as an example.
And let me point out one more thing, Wes, for the audience. So, and I don't think we had this on a prior handout, but what's the price to earnings multiple that Wall Street is going to put on a stock? Nobody knows that, but you can look at prior recessions and it's typically 15 or 16. So if earnings drop to 200 and you've got a 15 price to earnings multiple, which is not unreasonable, then that's a 3,000 target on the S&P. So you got to be careful. I mean, you got to be careful from a valuation perspective. If the recession is deeper than most people think because of the higher interest, because the Fed keeping rates higher, that's going to put more pressure on profits. And more than likely, it's just not going to be the first quarter. You can have this fourth quarter, the first quarter, and the second quarter of the decelerating profits. So the danger is really between now and the first quarter. Great.
Yep. And so with that, we're looking at the last large recession and a lengthy recession, and just looking at the VIX. We've talked about the VIX over and over again at these meetings, right? We want to see panic. We want to see panic, and we've made it this entire year without real panic. And just wanted to show this example of when we did finally see panic in 08. We're in this pretty volatile year still, right? When we're kind of bouncing between 20 and 30, but then finally that last leg where the VIX explodes past that 30, 32 number and hits that, gets to the 50s, 60s, 70s. You compare that to where we've been in this entire year, right? The same kind of thing where we've been between 20 and up to 35-ish, the entire year, bouncing around. And we still haven't seen the real economic impact of the tightening and of the interest rate increases, just because it takes time for those things to flow through. And I think that's what we're saying. There's still a risk. We're still planning for that, right? We're so lightly exposed that would be a great thing, right? Just to see the whoosh down, as Roy says often, and set us up for hopefully another several year bull market after that. Okay, and then this is something that Mark Minervini shared a little bit of, and just I thought it was a great example, right, where we see how difficult of a market you're in when the VIX is trading in between this 20 and sort of 33 range, right? And so you look at the 2000 to 03 market, and you're constantly in this above 20 number in the VIX, and it's not until you're below this 20 level in the VIX that you can actually be in an investable sustainable uptrend. Right. For now, we're just sitting here, we think we've got the fastest horses in the race, but you just get bucked off because the volatility is too much to handle. So, right, like, you get in an in phase that is an institutional favorite and solar and high quality and great earnings outlook for the next several years, but it makes a new high, and then 2 days later you're down 12% in the stock. So the only way we can really handle that is, or that has been helpful, is just taking extremely small positions, just consistently dipping your toe in, because it's something that, so you just can't get hurt, right? So we're just trying to wait until the volatility does sustainably decline, and we can actually stay in some positions and get a little bit larger without fear of getting shaken out. And so we're also wanted to show this. This is a sort of common talking point nowadays, is the Fed pivots, so stocks should go higher, right? And just wanted to show a couple of examples where I've highlighted what I'm calling the pivots here. I mean, there are a few more that you could probably highlight, but just as an example, in 2000, when the Fed paused, right? So if we're considering that a pause or a pivot, then there's a lot more downside. I forgot to add the percentage declines here, but a substantial amount of downside here, despite the pause and then ultimately cuts. Same thing can be said of 06, 07, right? The pause here. The Fed funds rate was elevated for several months, and then you see the more downside. And then obviously this one happens to coincide with a perfectly really with the bottom. This pivot where the peak in the Fed funds really occurred here, a little bit more downside. So basically all we're trying to say is while the market and the narrative seems to be focused solely on interest rates on the Fed, it doesn't, I guess if the Fed pauses, we still have to worry about economic gravity, and that's what we're considering, and that's what his message will be probably tomorrow, which it was the last meeting or the last time he spoke. They're going to keep rates elevated for a long time. I don't think he's going to speculate on an endpoint, but they're going to keep the Fed funds rate. That's their plan, right? They have to communicate that and come across like they're going to be tough on inflation. So that's what I guess that's what we're trying to say here. Even though we get some kind of pivot, the economic reality of that higher rate regime might show itself next year with earnings. Okay, and just wanted to show a couple more examples of these bear markets and how we have these pretty strong rallies to the 200-day, around the 200-day. This is in 01 and 02. And every time you get near these averages from you're rallying from underneath the long-term 200-day average, they've been selling opportunities, and I think we might have just done that again this year in 2022. And then just the other example of the more severe bear market, a quick rally to the 200-day. You didn't see it again later on, but if we compare again to today, right, we rallied a little bit above that 200-day back in March. We touched it again in August, and then we touched it again recently, and sort of blew past it for a few days. A ton of volatility right around that key point, and we saw today, of course, all that selling as we opened just above that level back in that high back in early early November, what that is, or early December even, and just sold right into it, right? So it just you can't chase, and it looks like that could be it. Maybe that is the end of the rally. I don't know. We will that remains to be seen, of course, but we know we're all very aware of these event risks that are out there, and today being the CPI and tomorrow being the Fed funds or the Fed meeting. So it's just, I don't know. It's hard to why even try to get in front of those when you see what kind of movement we get on these really highly publicized events.
And I'll make one point, Wes, as well. It's the last leg of the bear market that can break you. It can break your spirit, it can break your back, it can break your playbook. So you have to go, going through these bear markets, you have to endure. But our narrative, and I think it's important to have a narrative, and because that'll assist you in putting together a playbook, but then adjusting that playbook when your narrative changes and when the data changes. So what's primary in our narrative is that Powell has clearly said that he's going to break the back of wages, the wage spiral, wage inflation services that we've been involved in. And the only way that he can do that is make unemployment higher, is to start have companies lay off. And the unemployment rate is currently 3.7%. his target is 4.5 to 5%. He believes that it's going to take a number like that to slow the inflation rate back down to 2%. So that is, that is what you have to be prepared for. So that's going to take a toll out of our economy, a significant toll out of our economy if he in fact has to do that. So you've got to be careful on that last leg. But once you have that last leg, you will have stocks that have already bottomed. Many stocks have bottomed in the market that are down 90%, 80 and 90%. And it's still not clear who the next true market leaders will be, but they will hold up in the next leg down. So that's they'll stick out like a sore thumb.
Great. Yep. Okay, and just a quick recap. This is the number we got today, the CPI. I think the number was 7.1%. So, of course, it looks pretty clear that CPI has peaked. Inflation has peaked on a year-over-year basis. And like we talked about, pricing comes down. Those wages are sticky, right? And everyone knows that the wage part of inflation has been the stickiest. So if you have prices come down, wages stay up. That's the recipe that we're really talking about with the profit recession, right? Those are the ingredients that will fuel that. So this, while positive headlines, maybe makes interest rates come down, makes tech stocks apparently more attractive. In reality, we're contending with just slowing demand. So just keep that in mind. And here's something interesting that we're looking at with Hedgeye too, and it's the persistence of inflation right now that they have in their model, which I think is interesting. Yes, it's coming down, but then by the third quarter, they're saying it remains flat from the second to third quarter. So that being driven, I think, largely by rent and by the shelter component of inflation. So that's a kind of a major difference, right? If we do see progress on inflation slow at some point in the year, you have to keep that in mind, and that just kind of reiterates that they might have to just keep the pedal to the metal as far as the Fed funds rate for an extended period of time. Not necessarily keep going higher and higher, but it just might mean a longer runway of just maintaining that restrictive policy. And just so we're all aware, tomorrow it's the Fed meeting, and there's an 80% chance that there's just a 50 basis point hike that would be slower. It's hard to say who knows what the markets will do following that, but just because they've slowed to 50 basis points per month, now we're probably we're well into this hiking process. So, the next couple of rate hikes, I don't think matter that much. I really think he's going to just try to talk about how he's going to want to keep this, keep this rate elevated for some time until inflation gets under control. And here's a look at the curve, Fed funds next year, just to give an idea. The market currently is pricing in a peak of that 5.07% in the middle of next year, and then cuts by the end of next year. So that's interesting. That we'll see where these go, but of course that that means that they think that right now the market is planning for inflation to slow and become close enough to the target of 2% that if not undercut it, that the Fed will have to maybe do the opposite and loosen as early as next year. Okay, and here's a look at the Treasury yields. We'll talk
as early in 2024, right, Wes?
Oh, what did I say? 2020.
Yeah,
this is 2023. They might be cutting in 2023.
Yeah.
Okay, and look at yields. This has been a huge headwind to equities this year, especially the short term, we think, which is just the 3-month Treasury yield sitting here at 4.2%, the 10-year at 3.5%. So we'll look at the next slide where we'll talk about the yield curve inversion. So that's 78 basis points of inversion. Looking at the 10s minus the 2s on the yield curve. So, a widely touted recession indicator. And this is as inverted as it's been since the 80s, right? In the 80s, we had a sort of, I guess you could say, similar environment, right? You have a similar Fed chair who's extremely committed to stopping inflation, at least this time around, not so much in 2021, but this year, apparently, that's his number one goal. And, the Fed can do it, right? Volcker, his idol, apparently is, he did it. And it's, that the yield curve is telling us it's really telling us recession. That's what, and that's what we expect, right? We think the long duration bonds, while it's not that clear, I guess, if they make another move higher, with Powell's comments, but they should perform very well in a recession. I don't think I don't think he's going to let up. I don't think he's going to let us down as far as getting inflation back down to that 2% level. And if that's the case, and if we're in a recession, then everything points to lower yields at the long end of the curve. So we will see.
Wes, let me add one more point.
Yeah.
Folks, also, we're giving you and providing this slide deck so that you can take a look of not just what we're saying, but study the charts, study the graphs, study the things that you can utilize to make your own opinion. But remember, all this does is provide us with probabilities, and that's really what you're trying to do in the market as well. Is you're trying to put the probabilities on your side by knowing what historical data is suggesting. But just keep that in mind, and that's why you'll have some prognosticators on TV that they're not thinking we're going to be in a recession at all. You hear them every day. But the data clearly shows that going back for the last 43 years, the yield curve has never been this inverted and not go into a recession. And by a recession, we're talking about the economy slowing down, earnings are going to collapse, and valuations are going to have to be adjusted.
All right. Okay, here's a look at the S&P daily charts. We just continue to live below that 200-day. We talked about sort of short-term, intermediate-term trend turning up. We look at that 10-day green line over the magenta 21-day line. So that continues to hold, but we're bumping up again on that 200-day, a volatile day, sold into that open on the sort of, I guess, lower than expected CPI.
And we bounced to a declining 200-day as well. See, the 200-day hasn't turned up yet, and that's going to probably take a few months for that to happen, for that to occur. So I don't think this market is going to get away from us by any stretch of the imagination.
Mm-hmm. Okay, and a similar, chart of the Qs, but noticeably just weaker throughout the entire year. If you would look back at the S&P, of course, that big overshoot of the 200-day right here, and touched it here and overshooting again, but the Qs not making it to that 200-day average the last two bounces yet. So clearly the laggard here, and largely because of Apple, Amazon, Netflix, Google, Meta, Tesla, right? That we think have probably made their tops in the market for several years. And then the FFTY, another barometer of ours for the IBD 50 ETF, down, what is this, like 60%?
Yeah. And we were looking at this, and guys, this just made a low 2 days ago. And this, you're not going to find a very robust market in trying to find growth companies. Wes and I were looking at the IBD mutual fund index that's down 34% through today. I've never seen this index down as much as it is, and it just made a new low 2 days ago. So you're not going to have a robust market in growth stocks, and the stocks that we're trying to find that can go up many-fold, like Zoom did and Teladoc did, and Affirm and Upstart and these prior leaders. The environment's just not conducive yet. They're not popping. There's not a plethora of those that are showing themselves right now. So where growth is still struggling right here at the bottom, using this as a proxy.
Yes. Yep. Okay, and then as we get through some of these technical indicators, we'll go through these, and this is something we had noticed the last few days. Me and Roy talking about the MACD on a sell, a number of other technical indicators that we look at on AIQ and sell signals, right? So momentum waning, even though we've kind of got this anemic bounce the last week or so. So different things kind of conflicting with price, but then momentum indicators showing a deterioration there.
And Wes, point out we had this tremendous follow-through day. That's when Powell spoke.
Yeah, this is it.
Yeah, and we actually took the low out like in the last few days, and that almost assures you that the rally's going to falter when you take out the big pivotal follow-through day like that. And that was very poor action. And I guess that was, it's pretty much showed itself today. They sold right into it this morning. The market actually was up 900 points pre-market. I think it opened up 700, but people sold right into it.
Yep. And I think it's more glaring. You can really see it on, you can see it better here on the S&P, which is stronger, but then actually, a clear undercut versus the Qs. But that is a good point. We were looking at that. Not much to say on the RSI at this point. Just here's a closer look at the moving averages and what we're considering our trend indicators. Again, that green line above the magenta line, the 50-day turning up, but bumping up into this or coming into resistance really at that 200-day. That's also downward sloping. And if you that's an ugly bar. That's a lot of selling into strength on a bounce that only got you this far. So you have to maintain your caution here.
And let me just point as well, guys, that would be considered what we call a pivot point. So that's the point of least resistance once you clear it. And now this time, so we had horrible trading action today. They sold right into it. But if you can go sideways and the market goes sideways, build a little base, and then take today's high out, the market will be significantly improving. So, really, you could almost sit out until we take out today's high when you're looking at the NASDAQ stocks and growth stocks. But that's a significant pivotal point that we put in today.
Yeah, and just drawing that straight line, it's across it is interesting. It was support, on the way down. In early September, we got that first bounce, and the more it becomes more significant, right? The more times you hit it and don't go through it. So here we are, 1, 2, 3, bumping into that level. Okay, and then we look at this 30-week average for a long-term cycle analysis from Weinstein. Still not there, right? Still below the 30 weeks turning up almost. It's flattening right here, but we want to get a couple closes above that 30-week moving average too, to get us more long-term constructive on the trend. But for now, still just living below the 30-week average. Okay, and something promising with this rally, we are seeing some breadth improvement as far as this goes. This is the number of stocks above the 50-day in the S&P sitting at 82.6%. If we're going to get a rally that sustains here, we obviously need to keep it at that level. But that, obviously unclear there. And then looking at the stocks above the 200-day, again, seeing some more improvement. It's good to see, that we got more positive, readings this rally versus the past rally. So something constructive in this rally is that. Then if we look at the NASDAQ, just showing its, relative weakness. And again, this is where we are looking primarily for these, next leaders, really. Not as much strength here, only 47% above the 50-day with this last rally. Just, really notice the, it's a pretty anemic bounce, especially compared to the last, or the first two bounces that we saw in this bear market. And then the 200-day, so the number of stocks above the 200-day is at 33% for the NASDAQ. Also compares to that 64% in the S&P 500, which, makes sense, right? The S&P has all those healthcare names, has those utility names, has, other defensive areas. So, not so much in the NASDAQ. So we're just not seeing the same improvement here in this index. And then just more breadth analysis, right? The advanced decline line of the S&P 500. Not much to say here. It's not really trending either direction. It's kind of confirming the lower bounce. We're making both making lower highs in price, lower highs in the advanced decline line. And then here's the NASDAQ advanced decline line, where it mirrors the price action. Really, we're just getting not a lot of participation based on this indicator. And we'll continue to see that with other things like the net new highs and net new lows, really. So we've been at net new lows consistently. This is the NASDAQ net number. So we had one positive day. I guess that's first day of December. But we're still at that net negative number. One thing to take, at least while this has been a pretty sluggish bounce, at least the absolute number of highs, you can see that picking up a little bit, but still just not enough to outpace the new lows. And yep, so we'll extend that, give you some more context. Again, the 5-year chart looking at net highs and net lows. And yeah, just this has been a wall of red for a year and a couple months now. And we are seeing it get less bad each time. So that's at least one positive takeaway for now. But we've been washed out. There's a lot of pain out there. There are a lot of beaten down names that are down 80-90%, which is just gonna, that has to happen. We have to let that happen. So we can clear the deck and get rid of those non-profitable companies that really shouldn't have existed, but just did from easy money.
And guys, this compares, when you look, we've gone back to look at the data. This compares to the great financial crisis and also the internet bubble in 2000, 2002. It's extraordinary how weak the market environment has been, but I think we're just paying the piper for all the QE. And I think that's what's going to happen, and it's wringing out all the excess. So, this is as bad as it gets. But there is light at the end of the tunnel.
Mm-hmm.
when you
Yep.
see
And
this.
yeah. So looking at the 20-year chart, you're right. This as far as the length goes, right? The duration of that is almost 2 years, and the duration of this is, a year and a half of consistently having more net new lows. So yeah, the magnitude of this is serious. So it should be close. It should be getting close to an end. And here's the McClellan oscillator to give you a sense of overbought, oversold. And I don't think there's really anything to take away at this level or anything at this particular level, but yeah, we can I think move on from that. And here's a look at the VIX, something we're keying off of. We want to see, obviously, like we said, we want to see a lot of fear. Wild couple days in the VIX. Hard to really wrap your head around it. Very interesting movement in it yesterday. I was talking to Roy about that too, and how it was up 10% yesterday while the market was up, 0.5% yesterday, which doesn't really jive with what you'd expect. So not sure what to make of that. And meanwhile, we were noticing, even if you wanted to bet that the VIX was going up, the UVIX, the ETF to make that play was down. So I don't know, some funny business in the VIX, the last couple days. It's confusing, but either way, we hit that level just below 20 in December. We hit it below 20 in August. We went below 20 in April, but we're not staying there, and that's what we're looking for. Okay, and just longer term, again, more context on the VIX. We've been sitting here between 20 and 30. It's a tough market in that 20 to 30 level for volatility. And again, just waiting for a moment where we could see that VIX break to new highs for this year. All right, and this is a chart of the net asset or active manager net exposure. So that's actively managers and how long they are. They're only at 56% as of this week. It's off the low quite a bit for sure, but the active money is not has not really gotten too aggressive still this entire year. Continues to be cautious. Notice this is an interesting kind of trend, right? Each bounce, I think you have more and more caution, right? And I feel the same way, right? Because you want to add a little bit and test the waters, but you keep on getting burnt. So you say, okay, I was risking 3% of my capital. Now I'm risking 2. Now I'm only gonna risk 1. I'll be a little bit late. That's fine. I'm just gonna hardly risk anything and just test the water. So I think that's kind of an interesting trend throughout this year. Okay, and then here's a look at the bulls versus the bears. The bears continue to outpace the bulls, but the bearishness has come down a little bit from when it peaked back in September, when the bears were at 60%, and this is according to the AAII poll of bulls and bears. And here's that net number, so the bulls minus the bears. So bears outpacing the bulls by 17% here, and it's been an very long period of time to have that net bearishness historically, and again highlighted those instances in the past where we did have sort of similar bearish environments. Okay, and just like the VIX, the put call still have not seen a huge spike in the put call this entire year. We'd like to see a spike in that, showing some greater fear in the market, but not a lot going on in that area. This is the equity put call ratio. So just specifically looking at equities versus some other, I think, tools or instruments that are in this prior one. An upward trend, which I think is interesting, and I'm just I guess I don't really know what to make of it at this point, unless it's people thinking that they can, buy puts on the index and be long individual stocks that they think can outperform. Um, so maybe it's just a product of people being less long, thinking they can be less net long, thinking they can be good stock pickers. I'm not sure, but that is at least that's somewhat positive. I think that there is, consistently built, more and more fear being built up in this equity put call indicator. Okay, and then here's high yield spreads. We looked at this, or we talked about this, I think, earlier with some of the things we always look at. We're elevated. If we go into recession, this should spike also. Credit markets often can be, quicker than equity markets to see, legitimate concerning issues in the economy. So, we like to have this just to confirm, it might turn up earlier and give us an indication, that the bond market is seeing something, worse than the equities might be. Okay, and just a longer term chart, taking a look there. I thought this level would be more important, this 5 percentage point high yield spread, just because, back at the end of 2018, that's when we saw the Fed pivot at the end of that year, when credit spreads blew out to this 5.0 level. We did not see that, right? The Fed did not pivot, but it's something you have to monitor, because really this could be something that they're more concerned about, right? They talk about the markets need to be working. When credit spreads blow out to something like that, like a 9.5% spread, markets aren't exactly functioning, well. So again, just keep an eye on this, keep an eye on credit risk, consider that there's obviously going to be some companies that can't refinance when the time comes, and that becomes a real risk to a lot of heavily indebted companies. The longer that we maintain rates this high, they probably got loans out in the last 2 years with a 3% loan, and now they're going to have to refinance at something like 9 or 10%, and that's that may not be attainable even. So just an idea, something to keep in mind. Stay away from those heavily indebted companies. It might look like they're bargains, but if you dig into those financials a little bit, maybe you'll see, that's why, because there is, substantial credit risk out there. Okay, and just a few more things we're going to go through, but this is the all world index, excluding the US. So just to give you some info about the global nature of this. And I like to look at it and consider that the bear market in the rest of the country is, has already taken out that pre-pandemic high, right? We have not seen that level here in the US markets. But, a few months ago, the rest of the world did see that. So that kind of coincided with our sort of average bear market, I think, scenario too. Maybe even closer to the recessionary bear market, but just it is global. I mean, there's been a lot of pain in the markets elsewhere as well. Okay, and we continue to show these charts. Bitcoin just beaten down from its high, but man, that was a lot of volume back in November. I think when FTX went under, declared bankruptcy, and for whatever reason there's a pop today. I know SBF was taken into custody, but that's just news. But either way, this is a lot of volume. This is a lot of panic. We don't think we've seen that in the in the equities, right? But we may have seen it here. God, we've seen 3 instances of huge volume, huge spikes in volatility in Bitcoin and Ethereum. And I for one am not one to say that these would go to zero. I think that these long term could make some sense. And you've got you've got a line in the sand there that you could actually, consider if you wanted to. If you wanted to buy that, that's a lot. There should be support right there, that 16,000 level, as indicated by the chart. So just something I'm keeping an eye on. And Ethereum, similar story. The real interesting thing on these charts is, right here it's a lower high versus here, right here. Oh, and Ethereum, you're making that much higher low in Ethereum, right? And so the story being more use cases, the fork to proof of stake, right? So different things, I guess, driving that performance. Okay, and then gold, another asset class we're of course looking at. In quad 4, you would expect gold and the dollar actually to go higher together, according to the back test that Hedgeye has run. It's been the opposite, right? For most of this year, it's been dollar up, gold down. But if recessionary fears start to take the kind of front seat of things, then it should be gold up, dollar up, and rates down. That's the proper kind of setup that you would expect in a recession. So something that you should probably keep in mind, an investment that you could consider. It's above the 200-day, really strong bounce, and as real yields come down, that's where gold typically performs well. And so real yields, that's when the long end of the curve starts coming down. So it's an asset class. It's you don't get a lot of juice for your squeeze. I don't think with gold, there's not a lot of volatility to it. So feel free, but it's a lot of, sometimes it can be a lot of effort for not a lot, or you could try to get extra leverage in the minor names. Okay, here's a chart of the US dollar.
Oh, Wes, let me point this out too,
Yeah.
guys. If you look at I'm looking at the monthly on MarketSmith right now, just as a frame of reference. But in the great financial crisis of 2007 to 2009, gold actually came in. It wasn't a store of value. It wasn't a hedge, but it actually, after the great financial crisis, the GLD moved from about 70 to 180 over the next 4 years. So, we always look at things to look for parallels. So keep that in mind. If gold truly is going to have a major uptrend, it's going to last more than this 1 month. I mean, it went up for 4 years after the great financial crisis. So this might be the first month, of a 48-month move.
Yeah, that is a good point. And we've showed this in the past too, just to give you an idea. And I'm sure we bought gold, I think, earlier in the year. Thinking, look, it's a great breakout. It's a decade-long breakout, and so that is something to consider. Right, the long-term chart looks awesome, right? So, yeah. Okay, and the dollar, like we were talking about, it's been the opposite story, right? Dollar's been up, gold's been down this year. Real big pullback in the US dollar in the last 2 months, from its all-time highs. We're sitting here at this is the 50-week, so about I guess it's the 250-day or so. But like we've said, and like the kind of economic backdrop would suggest, is this should bounce potentially here, despite rates coming down. We know that the dollar was going up as rates went up the entire first 8 months of the year. But if recession is a concern and everything, then safe haven currency, right? So possibly a good place here to keep your currency in the US dollar. Lucky for us, most of us, we already do that. But okay, here's a breakdown in crude. Really significantly out the highs. This should continue to weaken too in the same scenario, but well off the highs, and it's going to be that's a big input, and we know that's been a big help for slowing of inflation and everything. Okay, and so like we were talking about, if rates are coming down, this TLT, this long duration Treasury ETF should start working, and we may have seen the top in rates and the bottom in this TLT, and I think that there's maybe some risk in Powell's comments tomorrow, of course, that he talks rates up for an extended period of time, and then we see one more move somewhat higher in rates, and maybe this thing pulls back, and you can get a better entry point, and that's kind of what we're considering. See if we can get a pullback, because it's just really been straight up from it's been kind of straight up from the end of October.
And this has been the worst performing period of all time in terms of stocks and bonds together. And you can see this TLT down from 150 to 92. I mean, this is staggering. This has never occurred before as rates have ramped up. But if there's one more move up in rates, and say rates have bottomed, but if there's one more move up in rates, this TLT is going to come down to that 50-day, which is roughly 100. And we think that might be a very attractive total return play from 100 to 120 over the next year, as you're getting paid a dividend of 3.5%, and you've got 15 or 20% upside just to come back into resistance on the TLT. And we think that would be extremely strong risk reward.
Yep, we do, and we talked about the AGG, which includes some corporate bonds, and that's just the issue is we don't really know about we just don't know about corporate quality, right? So this is just a pure interest rate play, risk free as far as your capital, if you hold it forever, or into maturity, but that's we like this play. We like the duration play of U.S. Treasuries. Okay, and the last chart actually is talking about those corporate bonds, the junk bonds, high yielding bonds, and so the J and K, similar looked as the S&P, but actually held up a little bit better. But anyways, this is what this is just another indicator to watch for corporate or for credit deterioration. But you're also going to have that positive movement as rates come down on the risk-free rate. You will get some benefit there, but the real, I guess, issue you have to worry about here is the black swan event and everything, and what might happen to high yield in a recessionary period. So that is it. That is all we have for now.
Thank you, Wes. Guys, let's take a 5-minute water break, and then we'll come back and hit it hard between 8 and 9. Our really formal comments conclude at 9, but we'll stay on as long as you want to talk about individual stocks. But I have about 20 stocks that I sort of want to take you through that might be the next true market leaders, and then we'll open the floor and discuss back and forth among the folks that want to throw in comments. So let's take a 5-minute break, and we'll get back here at 8:21 and get started.
Hello,
Yes,
Mr. Maddox.
yes. Is this
This is
James?
James. Yes, sir.
James, how are you?
I'm all right. I'm well. How you doing?
Fantastic, thanks. Good, nice to see you. Not actually
Yes.
seeing you tonight, but it's good to have you on the call.
Yes, sir. I do have a question in reference to that last bond play that you mentioned.
Okay.
I mean, I like the strategy. I kind of have been going with a little bit of that myself. My question is, why do you prefer the TLT over the tip? Only because currently the tip is offering a 6.5% dividend.
That I think what you're talking about, there's a minimum of only 10,000 invested in that. You can only put 10,000 invested in that, so it's a size limitation, I believe.
Okay, that makes sense. Thank you.
You're welcome.
Hello, is that only me or I don't hear audio?
Everybody's in break for a few minutes.
Thank
Sure.
Hey, Roy, can you hear me?
Yes, I can.
Do you mind a question?
No, go ahead.
I was a little bit late, so if you already have addressed this, we'll just go by it. But you made the comment that we're paying the price for all the QE, and I
Yes.
totally agree with that. The fact that we have not gotten even close to accomplishing all the quantitative tightening that they're talking about doing, how do we
Right.
factor that in?
I think we can't factor it in because it's never happened before. So it's all, it's all an educated guess, and it's all the market's going to tell us. But with all the QE, the idea that we didn't have panic in the equity market, nor the fact that we haven't even had an average bear market going into some of the poorest economic conditions that we potentially can have, makes me very, very wary. And it makes me very wary here. So, and there's nothing substantial that you can put a finger on. It's a sense of everything, of this really sort of common sense, thinking that, man, if the Fed, I think I think they've reduced the balance sheet about $750 billion. And they have they've got a couple of $1 trillion left to go. And it's not going to happen in 4 or 5 months. So, I'm very wary of that. And I'm very wary of the economic conditions deteriorating and the Fed having to raise rates higher for longer and the impact of that in the economy. And it's just an educated guess. But, after being in, 5 or 6 true bear markets, that's, you just garnered a little bit of experience.
I totally agree with you. And I guess the other side of it is, I think the market may force the rates up quite a bit higher. So it not only be on the short side, but on the long side.
You see, the Fed doesn't want, they want to prevent the wealth effect. And the wealth effect is when you make more money in the market and you spend more. They're not going to be able to accomplish their goals if the market keeps going up. There's going to be a disconnect. They're going to break something more than likely.
Yeah, just a follow up on the same topic. Is there any historic data that you know of, or that can kind of point to us on very large, balance sheet reduction by Fed, and is that a months or a year's process?
No, there's no protocol for that. This is what's going on. They'll write about this later, and that's why I'm worried that we have that third leg down, because we're at 4,000, I believe. 4,000 to 3,000, that's another 20% down from here. And that would put the market in an average bear market recession drawdown. And so, and we're not going to know if we go into a recession until after the fact, right? But the markets can tell you if the market fails here and starts to turn down after Powell's comments, I think there's a good chance that we recheck the lows and potentially go through it sometime in the first quarter of 2023. And that would be, I think, a perfect scenario for the end of the bear market. And in terms of magnitude and timing, I've recently read a study where the average cycle from peak to trough in terms of raising rates to the bottom, it's actually 25 months. And we started this in, I think, April. We've only been doing this for 7 months, but the average trough from peak rates to trough rates in other bear markets is 25 months. It's possible that this could go on for a long period of time and just wear everyone out, and this turn into like the great financial crisis and the internet bubble of 2000 and 2002.
Thank you.
Okay. Yeah, let's let's go ahead and get started. What I wanted to do is I want to just to respect your time. I want to I want to pull up, I think, about 20 or 25 stocks and that you should have on your watch list. I'm not, we own I think we own 8 stocks right now. We've got 2% positions in those 8 stocks. And then we have 2% positions in 3 shorts. We're short the NASDAQ, the S&P, and I think the Russell 2000 with 2% positions. So we're only net 9% long, and that represents our conviction. In a really strong bull market, we want to be 100% invested. That's how you're going to get triple-digit returns. But the environment's not such. You don't have many stocks participating, but we're going to show you the best of the best right now. And I guess at the top of the list is Enphase. So Enphase has triple-digit revenues, triple-digit growth. It's in a good industry because you've got incentives that the government is going to provide for the next couple of years. But we own this stock and doubled up on the breakout at 325, just like everyone else did. And then we inexplicably, the stock dropped after it squatted for a day, and it came all the way back down into the base, down $26 on no news. And we stopped ourselves out that half that day and half the next day. And then the stocks rallied back. So this is one of the leading stocks in the market with the 99 earnings per share rank, a 98 relative strength, but either our buy was flawed. Our buy wasn't flawed. It was a perfect buy. And we doubled up. That's the first time we've had a 5% position, I think, this year, and then immediately got stopped out because it was the market, not the stock. But if this stock can continue to build a base, then and if it breaks out again, probably the next time it breaks out, it will work. And I'll just go through a few of these global foundries. And this is the nature of the market today. You're going to see many of these stocks that can be potential leaders. They gapped up and closed at the low of the day. From a candlestick formation, you would call this a spinning top, which is a bearish signal, but it reflects also how difficult the market is. They sold right into it on pretty sizable volume as well. But look at the earnings growth. So we know that Biden's administration he's provided incentives for us to build more chip factories. I think Intel's got a big one going up. Taiwan Semiconductor here in America has got one going up. This is another domestic chip factory that's got tremendous numbers. And remember, can Slim true market leaders, you want them to have at least 25% earnings and revenue growth. Look at this, 999% earnings growth for successive quarters. And remember, I told you, look at this, 4 straight quarters of increasing earnings. So this has the characteristics of a potential new leader, and we're actually long this one as well. But notice where earnings grew from 18 cents to 42 cents to 58 cents to 67 cents. And the estimates are pretty good next year. So this is what you want to see in a potential leader. You can see the big volume on earnings that got our attention, where the stock traded up right there. Volume was up 175%. Stock was up 9% that day. So it was met with a very strong. So it had a very strong response to the earnings report. That's something that you want to look at. What are the other leading stocks in the market? We're actually long this one as well. Supermicro computer, and they've got the same characteristics. We're really looking for the stocks that have the best earnings growth and the best revenue growth in the market, and you want them near a 52-week high. You can see that it responded great to the earnings report. And then you can see the stock pulled back to the 21-day, almost got stopped out right there, and then it's rallied the last couple of days. What you want to see is this stock tighten up and get tight, and then take out today's pivot, sometime in the next week or so. You don't want the stock to take out this pivot tomorrow. Stocks that go straight up, straight down, and straight back up are prone to failure. You just need some calm action where it can go sideways, put in a little handle, and then it will set up for a buying it, breaking the pivot out. Mobileye, it's not a spinoff. This is a company that's owned by Intel that provides. I think Leidic is that right, Wesley? What's the technology?
Well, yeah, I mean, LiDAR being one of the
LiDAR,
components.
so LiDAR, and the numbers aren't great, but it's new merchandise, and Fidelity's in here, and the stock's making a 52-week high, and there's no overhead. So we're always watching, and this is a horrible IPO market this year. And so any company that can actually float an IPO and get away with it and have the institutions recommend it that's telling you something. I think someone put a $50 target on the stock today, but it's extended. You don't want to buy, extended. The stock has to come back in to either the 10-day or 21-day to set up and give you an opportunity to buy it. Elf Beauty, this is really what you're looking for, guys. And we are not in the stock, but look, you can see the stock from the market bottom. It was below the 200-day. You had crossovers in the averages back above the 200-day. And this is what you want to see in a good bull market. There are going to be so many stocks that you don't know what to buy, just like this. They're going to set up. And notice this, notice how poor the stock was performing. And finally, it got above the 200-day moving average. You had an earnings report, and then the stock just took off and just, every time the stock is pulled back to the 50-day, it's been bought. And, now you seem that's what you're really looking for. 99 relative strength, the relative strength line is at a new high, but it's just too extended. And currently, see what else we're looking at. PI, this has some of the best numbers around, but look at the volatility. And we got stopped out of this stock 4 days ago, and its stock dropped from a high of 129 to 111. And it was right on the cusp. We would want to hold it, but we didn't know if it was going to go to the 50-day or not. At some point you got to reduce, keep your stop at, anywhere from 5 to 10%, try to keep it between 5 and 10%, but you have to honor those stops, or the next thing you know, you'll have something down 50%. But it needs to just build a base. This was an earnings report, and this is what got our attention. And this had that great 10% update, volume up over 300%, to signify a change in the market's, in the stock's character. Volume was up 620%, stock was up 29%. That's why it got on our screen. And it got on our screen because of the earnings. Earnings were up 950%. Revenues were up 51%. And they raised their guidance by 45%. And you have great comparisons. They're going to do 260% this year and 40% next year. And the stock's at a new high. And they make all types of RFID devices to help you locate things and organize things. This has been one of the leading stocks, Sanmina, but they make printed circuit boards primarily. It's a commodity business, but the numbers are quite solid, and you had a great response to the earnings report. You want to be following all the earnings reports, because those are the ones that are going to supply the information that tell you that this might be a potential new leader. And you can see the stock break out on the earnings, now the pullback, and then you can see where the stock broke the 21-day, which is not viable. But if this stock turns back up and pivots, gets back above the 21-day, gets tight, then this could be a potential buy opportunity, a couple of weeks from now. This stock is acting great. AXSM stock made a 52-week high today. And you can see there's something that's common, guys, in just about all the stocks that I'm showing you tonight, is they've broken out. There was a great earnings report that was widely well received. The stock went up on the earnings report, and it's near a 52-week high on big volume. And these are the stocks that you want to look at. And what makes this stock so interesting is they just got an FDA approval. It's an FDA approval for a major depressive disorder, and they're using a pill, and it seems to have great efficacy. and it's selling well. And those numbers aren't reflected in the numbers below here. This is going to be a couple hundred. This is going to be a couple $100 million in terms of revenues moving forward in the next 12 months, going from zero. So there's going to be tremendous growth there. And the stock broke out, but paused, squatted today because of the market. And so keep your eyes here. This is a stock can easily go from 80 to 160. And that's what we're trying to do, is identify those, not the stocks that can go from 5 to 10, but the stocks that can go from 50 to 100, 100 to 200, 80 to 150. This is what the institutions are buying. This is an interesting company, Transmedics, TMDX. They got a novel approach to shipping human organs using warm blood, a recycling feature, and using warm blood instead of ice. And they reported earnings better than expected. This is a small company, however, and there's not a lot of liquidity. It's only trading 25 million. $25 million a day. But what makes this interesting, when you go back and you look at a company like Shockwave and look at Shockwave's growth, this is a company that's growing 20% sequentially. So it's a small company that has tremendous upside in a massive market. So this is where a potential true market leader could come from. Everyone's, I think, familiar that's following the market. They're familiar with Wingstop, and they had a great earnings report. Look at the stock gapping up on the earnings report, and they have a new chicken sandwich where I was told they sold a whole year's worth in a month when they launched the new chicken sandwich. So that was widely received. But this is the type of action. This is the action in a bear market. You try to go up and they sell right into it, but you just need time for this stock to just go sideways. But the action was terrific. The numbers are great. Revenues grew 41%, earnings up 55%, and the runway's quite large when you have all these, when you have the build out of these chicken franchises. And I will show you guys, I'll expand my watch list so you can take a screenshot so that you can take a look at these for your own knowledge and study as well. This Academy Sports and Outdoor that Bill Williamson has been talking about, ASO. Bill brought this to us like the last few months. And as in case you guys don't know, he's the oldest a member of our group at 91, I think now. And I try to have lunch with him about every couple of months. You'd be surprised at how much you can learn from an old geezer like that. People think I'm an old geezer, but you put everything in perspective, and this guy's going strong in the market still. So I love being around him. But he brought this to our attention. They've got low overhead, so of course they compete with Dick's. But he got interested in this after doing some channel checks, he told me. And they had a great earnings report, low expenses, and the stock's breaking out to a 52-week high. So the action is telling you, not necessarily the numbers, but there's something going on when you see a stock acting this well. And it could be expansion that's about to ramp up. You don't know, but it was well received on the earnings report. See what else we have here. Okay, so there's another theme going on, guys, and that's the build out in the internet in the rural areas. So there are a number of these companies that are beneficiaries of this. So apparently, these guys they're getting provided great incentives to provide internet in rural areas where the internet's not established. So in this computer networking group, you have a few of these. This is one. Notice how it responded on the earnings report. Then the stock pulled back. So this is setting up. It's extended now, but it's real thin as well. It trades about 35 million, right at the level that we're looking at exploring. But you can see the stocks in new high territory today, 98 relative strength, and very good growth numbers from revenue. So we think something's going on there. The leader in this group is ANET, and this just shows you the volatility. See, it broke the downtrend line, and we bought a little bit of this stock. I'm not probably right in here, like maybe probably around 135, and then it broke the upper trend line, and then it reversed, and we got actually kicked out, right at the bottom, and there's your downtrend line now. So if it can get through that, it's going to probably be the real deal. What you'd like to see happen, you'd like to see the stock go sideways, tighten up, and then take out today's high, a week or two from now. Just calm down and look at the numbers. So it's got great liquidity. It's trading 2.4 million shares a day. And look at the revenue growth. 57%, that's $1 billion versus 748. So this is not a small company. This is a really nice mid-cap company. And you can see the earnings growth. So this is a theme just like solar that can potentially work. And another one in that group is DGII. Computer networking. See, it's the number 4 group, guys. So it's the number 4 group. You've got the numbers that you're wanting to see. And there's, in my experience, there's 100% correlation over time with earnings growth and the stock price appreciation. It pretty much, the stock pretty much grows annually the way the earnings grow. Taser, AXON. That should be on your watch list. You can see it broke out on the earnings report. What's neat about Taser is they've reinvented themselves to a degree where now you got data. These law enforcement agencies they're using Taser's technology in the cloud to store all their records and information. So once you make that change from when the Chicago Police Department decides to go with Taser, they're not going to implement the technology and then get rid of them. It's going to be very sticky business. So you had a great earnings report, excellent relative strength, and the stock just I got close to a 52-week high right there. Another company that we've talked about, I think in the last meeting, was Dexcom. Dexcom came out with a new continuous glucose monitoring device approved by the FDA, smaller. Insulet, which is PODD, actually uses Dexcom's technology, but this is the leader in the group. And you can see relative strength over 95. There's the earnings report. And this is setting up great. It tried to break out 2 days ago, squatted, came back into the base. And this stock, this stock looks like a next potential leader with really solid growth. Earnings are going to accelerate next year from 20%, 30 to 38%. And so ideally, you should be looking for companies that have great growth and earnings prospects. Harmony Biosciences, biotech stock with really excellent numbers, making a 52-week high. And semiconductor company, ON Semiconductor. See, they're trying to set up But notice they, all these leading stocks, they opened big and then miserably failed. So it's either the stock's not ready or the market's not ready. But these, I'm showing you what are the potential new market leaders. And one that we're really waiting to pull back on is Halozyme Therapeutics. And they've got a proprietary drug delivery system that they partnered with some of the major pharma companies so that they can inject the medicine quicker using IVs. And you can see the stock broke out on the earnings report. And this stock's, it's you can sort of call that a lockout rally, where this stock hasn't even pulled back to the 21-day. So keep that on your list too. And when you look at these, when you look at a lot of these stocks, I just pulled up the weekly, they've gone sideways. This is where you get the stocks that can double over the course of a year. And, stocks that go sideways and then break out, there's no overhead. So, I always think that, when a stock has a chart pattern like this, as long as their business continues to grow, you've got 100% upside, from the breakout point. So, this is a stock that we think can go from 50 to 100 in the next year over the course of, 4 straight consecutive quarters where they beat and raise their numbers because their technology is being adopted. And NBIX, Neurocrine Biosciences, biotech company that's can grow 87% earnings next year. So some of these biotech companies, SRPT, NBIX, Moderna had good news today, mRNA, BMRN, they're all screening well. So this is where you should be paying attention to these companies. So these can potentially be new leaders coming out of this bear market. And look at this long base here. See, this is a stock that is trying to break out of a 2-year base. And when these stocks break out, when they break out, they can really go. So this is setting up to be a great institutional stock, $11 billion market cap in the number 25 industry group. Okay, so that's all that I wanted to bring to your attention right now. So the floor is open to you guys, and we welcome any comments, any stocks that you want to discuss, or anything regarding the market.
All right, I can actually give you a couple. C-Day and Kidney, Chinook.
Oh, yeah.
KDNY.
Yeah. This stock definitely looks great. And look at the volume today on that. And you're right there. I was looking. Yeah, I actually wrote it down today. I was looking on my notebook. If you can see my note, I don't know if you can see my notebook or not. You can't. Anyway, that's I'm not sure what I'm not sure what the drug is, and I don't know if this was a phase 1, phase 2, phase 3. What do you know? What do you know about it fundamentally? Why do you think the stock's moving? Who did they sign? They signed a agreement with somebody today, I believe, to market their product. Do you know anything about it? Yeah, go ahead.
Sorry, I was on a mute. No, I don't. I was just looking strictly at the chart. And,
chart looks, yeah. Something's going on here. Yeah, something's going on here. This is definitely one. Look at the relative strength. It's 98 at a new high. And, some of these stocks you're going to look back on and you're going to say, why? You're going to say, how did you miss it? And this stock looks fantastic. I would definitely, I'd have it on my watch list. The problem is, if a stock that doesn't have any numbers, you don't have any support, if they lose sponsorship, or they lose a drug or something like that, and the stock drops 50% overnight. But there's the risk. But I would say, I would definitely say this would definitely be on my watch or buy list.
Yeah, if you look at the weekly or monthly on the markets, it looks even better. Certainly, they don't have positive earnings at the moment, but certainly something seems to be building up over the last few months.
Yeah, and I actually, what's interesting is to me is that the stock finally, stock got hammered in the market. They're doing research, no product, so that's why the stock got hammered. And now, you can see the stock. Look at the blue bars of accumulation on the monthly. So, this has just been going on for 4 or 5 months. So this is under the radar. It's at a 52-week high, which is what you want to see. It's actually a 2-year high, at a new high. I agree. I agree. I love the way it looks, and I wouldn't be surprised if you if you look back a year from now, and it's a $50, $50 or higher stock.
Roy, I just joined.
Thank you.
I'm
Well,
sorry.
Yeah,
Roy,
hey, Brad. Yeah.
Hi, how are you, Roy? I
Great.
just joined in about 10 minutes ago. Now, did you talk about Solar Edge by any chance?
We didn't talk about, actually, we talked about in phase.
The fundamentals show great profit in 23. I found that pretty attractive.
Well, they do. Yeah.
Yeah.
It's coming back too. They had a poor earnings report. It sold off on an earnings report back there in August. Then you had the other earnings report. They missed, and the stock came down to 200. But so you had a shakeout there, and so I really like the way the stock has come back. And of course, Enphase and Solar Edge are the two. The two leaders in the microinverter area, and we think there's high conviction in the companies, in those two companies. You had First Solar. First Solar was actually leading, and then they have great numbers too, Brad, just like SEDG, and Wesley told me these guys are sold out like for the next 2 years. But this is action that you do not want to see. See, it went down 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 straight days. See, that's abnormal action. And now you're having the one day up. So
on a pullback like that, would you expect a little more of a gradual dip, more than that aggressive dip? The way, see how it's pulled back to 50 days? So
that's what I'm saying. I would have expected it to hold at the 21 day. And we actually own this as well. And we sold it breaking the 21 day because we didn't know where it was going. And there was no news. It should have held the 21 day. So either the stock's wrong or the market's wrong. So I would, you would expect in an uptrend, you would expect all these leaders to hold at the 21 day. And, the 50 days sometimes provides you with an opportunity, but you want the pullback to be higher. You want the 50-day to be higher. It's just too steep of a pullback. It's got its work cut out. That's really just a warning sign the way the stock is acting right now. And then of course, if the stock comes back all the way to new highs like quickly, then it's gonna probably fail because the angle of ascent is too steep. You want a gradual. You'd like for the stock to come up a little bit and just go sideways, come up a little bit and build a base, and then buy it, taking out 173.68. That would be the ideal setup on it.
Okay, great.
Hey, Roy.
Yes, hi.
Hey,
Yeah. Hey, Charlie.
hey, There's a high type flag in PBYI, Puma Biotech. PB with a B.
B,
Yeah, PBYI.
PDYI,
PB. B as in Bob.
B, oh, B,
Yeah.
PB.
It's a little.
So there you know, this is, Minervini's famous for putting on, and Mark Ritchie, he really loves these high tight flags or power plays that he calls them. And in a good market, these will take off. And these are stocks that, Charlie, as you know, just for the group, these are stocks that go up, say 100% in a brief period of time. And then you like to see them go sideways for a couple of weeks and then take out the pivot point right there. This is a perfect breakout. It's a low price stock, $200 million market cap. I couldn't buy it from an institutional standpoint, but that's a perfect high tight flag breakout right there.
Great. Thanks, Roy.
You're welcome. This ACLS, they're in the chip making business, like Applied Materials, Lam Research, and so forth. So you're seeing a stock that's making 52-week highs while the market's in a bear market, an $86 stock, relative strength of 97 in a good group. And I knew nothing about this stock until basically 4 days ago.
Did you talk about CELH?
Oh yeah. So CELH, this is a stock that we got kicked out of, I think, on our last meeting right there on the pullback. And then it immediately shook you out, made a new high, very frustrating. And, the stock is setting up. They sold into the number today, but this is really the easiest stock in our universe that makes sense, that you can easily explain. So I think this stock has great potential. I think it's got great potential. Pepsi's a partner. They're taking market share away from Monster and the other energy drink. I forget the name of the company. Is it Blaze, Wes?
You're thinking of Bang, maybe?
Bang, yeah, thinking of Bang. Red Bull. Red Bull.
Red Bull is the other big one, yeah.
The other big one. So I think this stock, it's the, so in a good market, you would have bought this stock today and it would have held. So it's just a reflection. See, it's trying to show itself. It's got, the revenue numbers are incredible, and the numbers are going to accelerate with the Pepsi, sponsorship. So I love the stock, and I think we have a position. I think we have a position in it. Wes, do we have a position in it? We do, don't we? 2%. So in a, guys,
Yeah.
in a good, in a good market, I'd have a 20% position in this, like today. Personally, concentrate, have 5 names, 20% in each one. But I have a 20% position. We have a 2% position. And because of all these whipsaws, and we're worried about, potentially the next leg down. But, if these things, if they set up, and forget about narrative, forget totally, narrative, the narrative, you've got to change your playbook if the stocks tell you to change your playbook. So we're not going to be so unchanging that we won't change our opinion, because we're going to be there on the turn, on the real big move, on the beginning of the new bull market. But you can see, we're showing you the potential leaders right now. They're not out of the gate. For stocks, if you expect Celsius to go up for 8 consecutive quarters for a couple of years, this stock is just breaking out. So, there's no telling what upside can be in something like this. You're going to find stocks. You will find stocks in the next bull market. They're going to go up 3- and 4-fold. So you have to constantly, you've got to be there. You've got to be there. You've got to do your work. This is a grind. The payoff is coming. Everything that you're looking at tonight and thinking about and studying, the reason that you're on this call is because you're doing the work necessary so that you're going to be there to have a triple-digit year next year. I'm telling you, it's coming.
Roy, I've got 2 stocks for you.
Go ahead.
AEHR
Okay.
and CPRX.
Okay, so this is one this has been hitting the screen, but it's so small, but you've got great action in the stock. It's got a 99 relative strength. But look at the revenue numbers. See, they're only doing $10 million in revenues. I mean, $10 million. This is a tiny, tiny company that have, but if they can, if they continue to grow, they continue to grow. It's got the market position in terms of the way the stock looks to be a potential leader. But look how wide and loose it is. See, it's, West calls these buck and bronco stocks. I mean, if you would have bought this stock any time where it made a new high, you got kicked out. You took an 8% loss. Anytime, so I would just like to see the stock cool off a little bit, build a base, but you can't argue with a stock with a 99 relative strength. And it is in that group that are stocks that I look at that have an earnings per share rank between 70 and 79 with a relative strength line greater than 85. You can have many stocks that have leaders. That's just kind of a niche kind of area. So I definitely think the stock should be on your watch or buy list. It's just a matter of buying it right. And Charles, who was the next one? Charlie?
A CPRX.
I've been watching this stock a lot, and this is this is an interesting stock because it's got earnings. It's a biotech stock, and that actually is accelerating revenues. They're profitable. Earnings 33% this year, 21% next year. I definitely give this stock a go. 99 relative strength. It's really a nice price too. And notice this. See, it's just breaking out. There's your real pivot was right there. See, it's 1722, and there's where it broke out. You can see it hit the pivot that day. And this is what I'm talking about, guys. So you want to see a stock come up here and then settle down, go sideways. See, it was too fast here when it went to a new high. They sold right into it, and now it's just setting up, ready to go. And it's only 60 cents above. See, 60 cents above the pivot, so it's not extended at all. I think this really looks promising. Thank you, Charles.
Roy, can you check out INSP? It's sleep apnea.
Oh yeah.
Yeah.
And
changes.
I had read a little bit about this, and when you have you get a lot of breakthroughs in the medical tech area, and I read a little bit about this in the last month or so. But you have really good action today on the breakout, and so this is stock setting up great. $7 billion market cap. So this may be the next great thing. Is this from an implant? Oh, or is this from an implant?
Yes, it is. It's I believe they implant, and then they it sends electric impulses to create a passage for the person to be able to breathe during the night, I believe.
That sounds Man, that sounds better than wearing a mask, does it not?
Yeah, much more comfortable, I think, yes.
Yeah, so this is definitely something that we should take a look at and do some research on. Thanks for bringing that up. I mean, that's where you get some of these new leaders from.
Yeah, it's something, it's a game changer in sleep apnea. I went right on their website and went on the investor details there. It's pretty good. It's pretty informative.
Thank you so much. I'm definitely moving it to my watch list.
It looks great on the weekly as well, Roy. If you look, it's got it just broke that kind of a down.
Man, that looks great. See, this
Yeah.
is look at where it broke out. See back here, on the weekly. See, that's how
Got
you
a
get
long
your
day for-
see. That's how you get your doubles. See, it
Yeah.
broke out at 100, went to 250. That's what we're looking for. See, in a good environment, and this thing is just now going. I mean, I think it looks fantastic. Not many shares outstanding, so you can have some splits in there. I think it looks outstanding. There's the monthly.
Yeah, she's ready to go.
She's ready to pop. And there's your, the monthly.
Waiting for
Once
the
you
market.
get one of these, this thing looks great. It's a matter of not overpaying, because if the market might not be ready. It's, typically I would buy something like this, like on day 2, this thing pulls back, but it doesn't undercut the low. Just from a tactic standpoint, if this stock pulls back, but doesn't take out that low of yesterday, and, this would be, you'd be buying the stock, close to your stop out point. And in a good market, it won't take out the low. Like, it'll come in tomorrow, the first 30 minutes, put in a low, and then you buy it taking out that high. It comes in, then it comes in, takes out that high, and then you have a great place to put a stop, which would be tomorrow's low.
I got a small position currently. I don't know if I should be adding or just wait for it to come in. It's just a small little 1% position because of feeler position. But
I would just, you got plenty of time for it to go from 250 to 500. It's not going to get away, but it depends on if you have a profit in it.
Yeah, I bought it a couple of days ago on that tight little action there.
Yeah, so you got a profit in it, and I mean, I would, I think you've identified something big here, and I would want to have a 10% position, but the market's got to cooperate.
Right.
And so how do you work your way into a 10% position? And it's just going to take you a little time, but if, tomorrow's going to be important to see if it acts good the way that I just told you. If it comes back to 250 and then takes the highs out,
Right.
I would consider adding a little bit more, as it moves up, and then see if it, just see if it'll go sideways a little bit, and then, add a little bit more, but try to get yourself, if you've identified a true leader, that's what you want to do. You want to get to a 10 to 15%, 20% position if the market's truly in a bullish mode. And the market's not in a truly bullish mode there, so just keep that under wraps.
Thank you, Roy.
You're welcome. This is another medical company, MedPace Holdings, clinical biotech, broke out on the earnings report, but look how sloppy it got. But they've sold it every time it's moved up. But this is another potential medical company that's leading. Oh, Nutanix. I think somebody mentioned this on our last meeting as well. See, this is exactly, it hasn't given me an opportunity to get in, but there's the earnings report, gapped up. The stock was up 24%, volume 383%. And as you guys know, that's that 10-300 look that I'm looking for, when you get that action that's confirmed by price, that's telling you to like to put it at the top of your list. And now look how this is exactly what you want to see. Look how tight that's gotten. It's pulled back to the 21-day once and then held. So the last 4 days, I almost bought this stock right there 3 days ago for clients as well as myself personally. But I didn't want to go into this the CPI, the PPI reading, the CPI reading, and Powell. But great numbers. Earnings were up 114%. A great reaction to the news, and that's perfect model action. That's exactly what you're looking for. So moves up, stair steps, pulls back a little bit, goes higher, pulls back a little bit, goes higher. This is the exact action that I'm looking for all the time in great leading stocks. And what does that look like on the weekly? I mean, this thing looks great.
Sorry, a quick question. By the way, what is 10-300 you mentioned, or 100-310?
Yeah, it's the characteristics that I like, that I've often found for great leading stocks. When the stock goes up 10% in price, at least 10%, and most people are afraid to buy a stock that's up 10 or 20%. And that, in fact, is right when there's such demand for the stock that it's up more than 10% in price, and volumes up 300% over the average 50-day volume. Those stocks typically go higher. And for example, here's First Solar right there. And the stock was up that day 15%, volume was up 374%. And I never got an opportunity to buy it because it never pulled back. It just locked you out and continued to move up. And I think the second time around we ended up buying it. But that's a characteristic that I screen for every day. And for example, these are screens that Wes and I run just to try to not miss anything. And there's the 10 up 10. These were stocks that were up 10% in price today, at volume greater than 300%. This is where they show up. Like Moderna, for example, announced some promising results for a cancer vaccine. So this could be right off to the races right now. Look, it's going sideways for months, and look at the volume today. Volume was up 426%, and the stock was up 20%. So you want to. This is where the new leaders come from. This is where stocks. This is how stocks double. They can go from 200 to 400 over the next year. But that's when they start their move. That's when institutional support comes in, because typically there is a catalyst. And today they released a promising cancer vaccine, and for skin cancer, and it's for to prevent the recurrence of skin cancer. So that's why the stock's up.
Yeah, that's definitely huge volume. I would have just mentioned the same thing, that now that you explained what 10-3 is, this today was the Moderna's day.
Yes. FLNC, we've been watching this one. This is a solar, not solar, energy storage company. And they raised their guidance today. Their backlog's over $2 billion. No one's heard from it. It's in the solar battery area, and you had a day where the stock was up, taking out the 2109 pivot. And so that's the action. See, nobody's following these, and everybody's following what's Tesla doing, what's Google and Amazon and Apple doing, and they're going to miss the next stocks that go from 20 to 40. It's over in the queues. I mean, it's over for years, and it wasn't over 2 years ago at the 2020 bottom, because those companies were continuing to grow. they were growing, they have liquidity, big moats, big market caps, but now they don't have the growth. And so, these stocks are over for a long period of time when you have negative growth. Google, their business in advertising, they're 5% this year. They're not going to be up 11% next year. And the stocks, they're telling you this. We think that we've made, just like when Google peaked in 2007, you didn't make a new high for another 6 years. And we believe that it's over. You've had this big move for 10 years, 12 years. And this is, you're going to have to, we believe that, that these are crowded trades, and you're going to have to find the next new leadership, like these companies. Some of the companies that we talked about tonight, like, INSP and companies like that. So another biotech company, there's going to be some great new innovation, great new drugs, and they're going to show these. You're going to have companies that have zero revenues and zero earnings that are going to turn around and have great revenues and positive earnings. That's where I think a lot of these stocks are going to, where they're going to emerge. I'm real keen on the biotech area when you have new drugs and new revenue streams and a proprietary novel new treatment. So there's the 10-3. I run this list every day and then look and see, well, what is the news? Is the news worthwhile or not?
What about Dexcom? I don't think you talked about Dexcom yet.
Yeah, I did. Is that Joseph?
Oh, you did. Sorry.
Yeah. So, I talked about Dexcom. I pulled up the chart with the, they've got a new product, new FDA approval. It's the best product, great action, and we're long this stock as well. And we'd like to get longer. You had the great breakout. Now it's failed. The market, I wouldn't be surprised, and we'll be frustrated, if this thing drops to the 50-day. It needs to hold right there at the 21-day. And the sister in that group is Insulet. And there's the breakout on earnings. And this is in a bull market. And I guess in a bear market, too. We're following the money. It's you want to follow, well, what is Fidelity doing? What's this stock that most of you guys aren't familiar with has 1,325 mutual funds that own it. So they've got, wireless handheld insulin system for people with insulin. That's a wearable device, and they use Dexcom's technology. And look at the A+ funds from IBD that are in it. So there's your confirmation. You have the best. They have been the best performing mutual funds on the planet for the last 10 years in growth. Remember, they're down 34% on average this year today. So, there's a lot, when this turns, you're going to have many stocks that set up like this. There's the earnings report, and look at the earnings growth next year, 88% this year, 151% next year. That's just superior. This looks as good. And I said that, nobody knows about it. Probably, $100 stocks that people aren't following. So the last couple of years, but look at that great appreciation. This is a perfect bull market. This is just perfect. This is a perfect bull market stock where you're trying to get something that can go from 300 to 500, 500 to 1,000. And it's all based on, it's based on their earnings results. So they're going to have to continue to have great earnings. But, this should be your fishing ground right here. There's that CPRX. This is stocks that have a 99 earnings per share ranking and 99 relative strength. David Ryan told me over the years, and I had the privilege of attending in the late 80s, I think 2 or 3 seminars with he and Bill. And this is when he had won the US Investment Championship 3 straight years. And I asked him, where did, if you had back then, what was your number one? And he's changed his methodology a lot. He buys more pullbacks now than breakouts. But when he signed my book back in 1988, he said, buy breakouts and buy 99 earnings per share ranked stocks and 99 relative strength stocks, stocks that are so superior that they have a 99 earnings per share rank and a 99 relative strength. They're so superior and so rare that, when you get them and the market environment's right, that's how he generated his, 150% returns for 3 straight years in the 80s. So I really like the way this CPRX is setting up. That looks great.
Roy, would you ever buy a stock like, say, Pins? Pins had a fantastic day today with heavy volume, and it held up like a champ. If you look at the 5 minute, it held up pretty strong all day, even when the market pulled in a little bit. A lot of positive chat on it too lately.
And I'll pull up. And you have some of these bottom fish plays that, yes, you can try these. And we actually tried 2. We tried Toast, TOST, and 4, and got kicked out of both of them. What we liked about them, just like this Pins, it was setting up. It was setting up. It's been in a big correction, and it broke back above the 200-day, and the 200 days, starting to turn up. And take a look at it on the weekly. Yeah. And this is really a sort of a turnaround situation. I'm not saying it's a turnaround situation in the business, but it's a turnaround situation in the price, where it was one of these high PE stocks that got hammered, and now it's building a base, and it was in a stage 4 downtrend. I wouldn't consider it right yet. It's right there on the base of going to a stage 2 uptrend. So, if you're a Weinstein guy, and I used to subscribe in the 80s to the Professional Tape Reader that he authored, and that was his preferred way of buying, and waiting for stocks to go in stage 2 uptrends. That means they're above the 30-week moving average, and then they pull back and you buy it. And so there's nothing wrong. It's just a different strategy. There's nothing wrong with buying something like this. And some of these stocks can move up high. It's just you have all that overhead, so you can get stuck with it.
They do have a new CEO now, and apparently I don't go on Pinterest myself, but my wife tells me that you can actually buy the product that you're looking at right on their website right now. It makes it a lot more user friendly. Those that use it would know better than me, but I mean, apparently it's becoming a lot more user friendly, where you can actually buy the product.
That sounds like a game changer.
Yeah, that's what I'm thinking.
That sounds like a game changer to me. I think definitely we should look at that. I tried this 4 Systems, FOUR, and this is, and we bought this stock. I think we got stopped out of it.
By the way, Ray, I think in a Pinterest, there's also an activist management coming in place. I think it's an Elliott management or somebody.
Oh, yeah, that's right. That's right. Yep. This is one of those Kathy Woods, Kathy Donnelly's trades, the life cycle trade where, it was an IPO, was hot. Then you went through this correction phase, and now it's breaking the downtrend line. And we actually bought this breaking, I think, the downtrend line, and right there, and got kicked out. Got kicked out within the week as it right there, and now it's working. But many times when you have these stocks that are in these downtrends and then break the downtrends, now the move's on. And what we liked about it is earnings grow 200% this year and 50% next year. And we think that they've got a wide range of products that can be adopted. And so this is one just like that, pins, and now it's firming up, and now it's clearly in a stage 2 uptrend now. But I'm guessing that we bought the stock there and got kicked out with the market right there. Then it firmed up, and we could have got kicked out right there. I'm not sure, but that's another one that's setting up with great numbers. Look at the revenue growth. So they're doing $2 billion in sales. See, what I like about this, they're doing $2 billion in sales. It's only a $4 billion market cap, and they're profitable. Another bottom fish play. Look at this DocuSign, guys. So when you say you can buy, I'm just sharing with you a typical Can Slim O'Neill approach, but there's many different ways of achieving your goals. You can be a value investor, but you just need to have discipline, because you're going to get stopped out quite a bit. You're going to be wrong half the time. But look at the volume on this DocuSign. So DocuSign down from 314 to pretty much bottoming a week ago, 300 to 40, down 90%. And then they came out with earnings, and I think they raised their guidance, and a great company. And look at the institutions that are piling in there. Look, that's 10 million shares a day. So look at the average volume. See, look at this, the last 4 days, and the stock has gone up 40 to 60. It's up 50% in 3 days. So you can get snapback rallies, but many times you get buried in something. There's Zoom, which hasn't, you could typically, you could guess, but we never buy stocks under the 200-day moving average. It would never. It would have to be in a stage 2 uptrend. This is just dead. Kathy Woods losing money for Teladoc for 8 straight years, down from 300. This is I think one of her top 5 positions, and it's down 71% right now. It was down 80-something% at the low. And more than likely, just from experience, you don't have many that work like a DocuSign. You can get, and the ones that don't make money, you're just at great risk. So, thinking that all these stocks are values can lead you, that's just not an effective way of managing your portfolio when they're technically inferior. Asana, I'll just show you this. This stock's 145 to 18, and the CEO owns maybe I don't know how many million shares he has, but he's doubled up the whole way down, and he's lost like $500 million in this stock. The CEO's buying it all the way down, and he's down 500 million. So that's an easy way of being a billionaire, going back to a millionaire. But,
Hey,
yeah.
What do you think of Boyle?
I think it's a short. I shorted it today, and I think it's a weak stop, bouncing today. See where it bounced before. So this is results corresponded to nat gas. which has been in a bear market. I'm looking for that. I'm looking for the same move. See what nat gas, the move up and then the turn down. So I put a little bit of that on today with a 1 bar stop.
It looks to me like it bottoms out in December, like pretty much every year. And then it has a good run until the summer.
It's December. It did back then, did it not? There it is last December. But the ones that are leveraged like this, there's so much decay. They're leveraged with derivatives in most of these. And occasionally I'll play one of the leverage ETFs, but like we're short just a single ETF indexes now, not leveraged, because they don't move dollar for dollar. You lose money because in slippage.
Okay, thank you.
You're welcome. And by the way, see, I think there's a good chance. I don't think there's any question that oil prices have peaked. And look at the disconnect between oil prices. So oil prices went up, they went parabolic, came in corrected, made a double top. And then that's what's going on. Oil's gone from $130. This is the USO ETF that tracks it. And look at the bear market that we're in with energy. And so everyone expects energy going into December, oil prices to be really high. Why not? I think that's because demand destruction is taking place. But with energy prices here, I don't think there's any question. And I also shorted the XLE into today on this bounce. And because you've got peak price, you've got peak earnings in the OIH. And if you look at a lot of these oil companies, the leaders in Matador, MDTR, MTDR, look at the earnings. See, earnings were up 150% this year. They're going to be down 12% next year. And this is just like the shippers. So you can pull up a number of the shipping companies, like the Israeli shipping company that was so strong earlier. And it peaked. Who's that?
You're thinking of Zim?
I am, yeah. And notice Matador. See, I believe when you look at these earnings, look at the 300%, 227, 240. See, now I think you're going to see, because oil's going down, you're going to have peak earnings out there. And so I think you short energy on the bounce. So this has been, you'll hear people talk about on TV, they're cheap on a PE basis and all that. It doesn't matter when you have peak pricing. These stocks peak at peak earnings, not when, it's been a place where people have hidden, and you can see the break there technically. So this is, I believe all these stocks are shorts in my view. Oxy, OXY, look at it, try to gap up today, and it was up only 25 cents. And I think you're going to look at peak earnings up 900%, 888% in June. See, so I think that's a double top, and I think you've got to be careful. You can see the relative straight line peaked long time ago. So, and I've been totally wrong on these energy stocks too. So, I didn't buy any of them this year, where it was the only sector I think that worked, for the year so far. But I am aware that, that what happens when you have peak earnings. See, there's Zim. See, look at this. See, this is what I'm talking about. See, you had peak earnings back here. You had, so right there, then the slowdown. And so you had peak earnings. You had peak earnings here, then you had the double top. And this is what this is what I could definitely see in the energy stocks. That right here, they're weak, they don't get out of their way. Then they make the next leg lower as we go into the recession and so forth. So be really careful in energy. I really think the group's a short, on the strength, short on the bounce, and, anything's a trade. If you're wrong, just, take your loss and move on.
Hey, Roy. This is Sujay.
Hey,
Just
how
had
are
a
you?
question regarding good. Question regarding market leaders. Would you consider Richardson Electronics, ticker
Oh yeah.
RELL?
Yeah, I like it. I think it looks great.
Extreme. I have three actually. Extreme Networks,
Yeah,
EXTR.
hold on one second. Let me write it down.
Sure.
RELLEXTR. And who's the last one?
Hudson Technologies, HDSN.
HDSN. Man, well, first of all, this is my style. Right here, this is my go-to. And they manufacture RF microwave components, power grid, sounds great. Look at the earnings growth. That just flies off the page. Earnings growth 500%, 800%, 300%, 100%. It's a small company. It's a tiny company. Look at the market cap. 363 million, not even. So this is really a tiny, small cap company, but they're growing. But what they're doing is they're making money and they're growing sequentially. Say, look, 54, 55, 61, 67. Say the next one's going to be, 72, and they'll be up, 30% again. So they're managing the business right. So I love the idea. It acted great on the number. Great 99 relative strength, the strongest relative strength. I think it looks fantastic. It's just a matter of buying it. You can see where, it's somewhat extended from your buy point where it came back to the 21 before and held 21-day moving average, the EMA. So I like that one a lot. I think you got something there. I love the way Extreme is acting in the number 4 group. Number 4 group. I owned this stock years ago. I'm trying to think when. I definitely was familiar with it. I can't remember when during these periods of time, but the stock has great action. Not great. Earnings are going to be good this year and next year, but the quarterly results, haven't been that great. But they have the wind at their back with the incentives by the government in the in the internet area. So I think this one looks great. Small market cap too. See, 2.6 billion, and they're doing the really good numbers. 300 million in revenues. So what you're probably seeing, and the stock went up on the number, you're probably seeing Wall Street start to take a look at their backlog, and they're probably getting under the covers to take a look at the growth rates. But I think you've got something here too. So not a lot of people have heard of this company. So it looks good it looks good. There's the weekly, it looks great.
Yeah, it has been respecting the 21 EMA as well. So
it has. There it is, right there. And it's an easy stock to buy as long as it holds the 21-day. I really like that. I think it's on my watch list as well. And I pulled this up a week ago on this Hudson, small company, $500 million in market cap, and they're doing, what's that? 280. They're doing $300 million. It's a price sales of less than 2. So on a valuation basis, it's dirt cheap. but I don't know exactly what they do. Refrigerant reclamation, sales, and decontamination to refrigerant wholesalers, contractors. So I guess it's in the construction business, but it's got great relative strength, and it hit my screens because it was between 70 and 79 with an earnings per share rank greater than 85 relative strength. I don't know how big the business is, how big this can grow, but I don't know if it can grow in a slowdown, but it's in a top 40 group, so it's definitely showing itself.
Thank you. Thank you for taking a look at these.
You're welcome. That Target Hospitality they've got really good numbers coming up, and this stock has got a great base there at 15. So I haven't done much work on this one, but as Charlie mentioned before, this got my attention because this is a power play. See, it went from 5 to 15 in a brief period of time, so it doubled. And then you would typically, when it goes sideways, now see it's typically going. You would like for these stocks to go sideways, and then you buy the breakout. Here, it didn't work right there at 1567. They sold into it, and I think I probably bought it personally then. It's very thin, and then I probably got kicked out. Probably, breaking the 21 day, but this is setting up quite nicely too. I encourage you to do some research on that. Look at the numbers, 81, 80, 109, 159. So if they do 180, revenues are going to accelerate. Revenues are going to be up 100%, and you can probably see, earnings up a lot. 500% or so. A lot of good stock identification tactics occur when you're just looking at you look at these stocks and you pull them up. I love MarketSmith, and you pull them up and you can just make some deductions, and you can read a little bit about the company and look at what the estimates are, and you can see that this is how companies accelerate. They continue to accelerate, and so the next earnings report is probably where it goes. It's probably when it goes, but it's trying to go right now. Guys, let me show you this. You can take a screenshot. This is what we currently are looking at. Maybe this will be helpful. And if you want to take a screenshot, go ahead, and I'll scroll down here in about 5 seconds. So this is what's got our attention right now. So hopefully this will help you identify and cut some time off of your research process. You're going to find that most of these have very strong relative strength. If you look at the relative strength column, see, look, that's sort of where we're focusing. Relative strengths are all in the 90s mostly. So that means they're outperforming 97%, 95% of all stocks that are traded. So you're getting the very best merchandise.
Roy, do you ever look at of strength or the 6 month with MarketSmiths? Like,
I don't.
No,
I don't. I just use the default, but I do run the. Let me change. Let me go down to a couple of lists that I have.
Minervini has a 3-month Minervini trim.
Yeah.
No,
A
it's
trend
pretty-
template. Yeah, and
Yeah.
I've definitely looked at that. So where you find that, you open stock ideas. And Wes and I talked to Minervini. Minervini's struggling right now, to be honest. And we're actually subscribers. He does help us, but he's getting chopped up a little bit now, and he can't make headway. It's just the nature of the market. But you put trial positions in there and try to get some traction. That's all you can do, and just try to cut your losses short. And here's Minervini's screen. So if you pull, that's from the weekly. That's where you find it. And there's some different criteria on his screens, but he only will buy. And so these are his screens: the 1 month, the 1 to 4 month that has a different criteria, and then the 5 month, and then the 5 month wide, which has more stocks in it with less specifics. David Ryan uses this 1 month template a lot. That's where you're in a stage 2 uptrend. You're within 15% of a high. The relative strength has got to be over 70, I think. It's got to be in a stage 2 uptrend. The 200-day moving average has got to be up at least a month. So these are some useful screens to run as well. And the reason that you run these, this is where you get the power plays. And Mark Ritchie, his partner, often identifies a number of those power plays or high tight flags. And they show up here. A lot of those show up here first. And so you can look and see what the list view details. You can see what the criteria is. Oh, and by the way, it's got to be above the 50-day. The 21 days got to be above the 50-day. It's got to be over the 200-day, and all that criteria is in his books. And I highly recommend Mark's books. We're big fans of his. And his volume contraction patterns, and that's a guy that doesn't change his methodology at all. He'll hang up on you if you talk about buying something that's off the bottom or a bottom fish play. It just annoys and irritates him because he's made his fortune just doing one thing. Volume contraction patterns. Relative strength. There's so many great screens. I mean, a lot of this is just, it's just doing the work. And if you love doing this, here's the relative strength within 5% of a new high, 53 stocks. And a lot of the screens that you run, you can find the leaders on things like this. Relative strength is within 5% of a new high. And let me show you what's on our watch list. IMCOR, Array, Harmony, ALGM, NFE, there's 4, there's GFS, Shoals, Mode, Shockwave is there, but we got kicked out of that months ago, I believe, weeks ago. There's that Toast. So this is, half the battle, guys. It's knowing what to look for and then identifying it, and then again, having a feedback loop so that the market is telling you whether or not the environment is good or not. I think that something like an Airbnb, but I guess we're going into a recession, but I'm waiting for this stock to have a big move. Coming out of the IPO, it's, everybody's aware of the company. It's just the market action is horrible.
Roy, can you check out AMBA and Barella?
Yes, for sure.
On the weekly, it's got a lot of recent accumulation that's kind of impressive. Fundamentals are not perfect, that's for sure, but
There's the, let me just look at the daily. Yeah, I don't like the fundamentals at all.
no, that's the
I
only
just,
the downfall.
yeah, there's, you know, and this is, I mean, this is, I can't, this has no fundamentals. I mean, I heard people talk about Broadcom, but you know, look at the, I mean, I'm not going to buy something with an 8% earnings growth this year and a 6% earnings growth next year, and they're going to probably be lower, you know, going into recession. You have to have, at least now, you have to give the analysts the benefit of the doubt that they can at least do what they're going to do. But, you know, a stock growing 6%, they're, you know, we're looking for the stocks that are growing 100%, to be honest with you, you know, and you're going to stumble in when you can get the right market. And a number of these that we talked about tonight, you know, the market environment improves, and then you're on the right stocks, and then it becomes easy, and then everything's working, you know, and then everything's working at one time. This Coupa got these stock, got a lot of these cloud stocks. They were bought out at a 26% premium yesterday. And so this is a stock that was down from, look, 377 to 40. I mean, that is just, and you know, you got to pop. I would never buy something like this below the 200-day, the whole way down. This looks like a Kathy Woods specialty. But then they were bought out, and that helped the market. That did help the market and helped some of those cloud stocks, thinking that finally they bottomed, like a Twilio. What's Twilio look like? Twilio 49. Look at that, $450 to $49. Guys, I haven't seen it down 82%. This is as bad as I've ever seen it. And these are companies that actually have numbers. They're just, I mean, they have revenues and they're actually doing something. This is unlike the internet. I haven't seen anything this bad since 2000, 2002. It's been 20 years. Just the new high list shrinking, the new lows expanding, staying there for a year. I mean, this has been, you know, a miserable year in terms of having to grind. But, you know, just grind away, because I know how profitable it is the first 3 months of the turn, when when the market turns, not the indexes. See, it was easy to buy the indexes at the 2020 bottom. It was real easy to buy the QQQs there, but that's because they still had great growth. Now you're having them decelerate. So that's why I think it's going to be years before you take out that. So you don't, like, if the market gets hammered from here, you don't want to be buying the Qs or that stuff. You want to be buying these stocks that we talked about. Those, you can find the stocks, you can get a bounce on the indexes, a little bounce, but they're going to be sold into it. This is going to take a long time to repair. And, you know, I think technology, I think it's about 42% of the S&P right now. I wouldn't be surprised to see that get cut in too. And Apple's 7% of the S&P. And they all hit, they all go to the 50-month. And I've been talking about Tesla. I've been tweeting about it a little bit, saying that Tesla's going to the 50-month, and there it is, from all the way from 300 to right there to the 50-month of 158. And so it hit 158 today. And that's what that's how these bear markets, that's what happens in these bear markets.
Hello, Roy. This is Tim. I got a question for you.
Go ahead.
I was going through some screens because if you go to MarketSmith and
Yes.
you check out their screens, and down below they have a thing on the very bottom. They have a stock guide. No, if you go on the top, very top, and on the left. Yeah, closer, more to your left, and there's those little arrows. And then you go down the very bottom and go to stock ideas or stock guides.
Okay.
Well, I thought my reason is my question is this. In one of those things, they have a thing called the high type flag. And there's a particular stock, PRTA.
Oh yeah, I'm familiar. I mean, I'm familiar with this. Is a Mentor Vinny special that he got stopped out of. And thank you for that, Tim. I didn't know that they had this down here, stock guides. There's
But I go into the coaches segment right there. Is about like the fourth, fifth one down. They got some great ideas in there, but when you're trading a high tag flag like that one there, without earnings or out anything,
yeah.
what exactly are you looking to how to get in to something like that?
I'd love for the stock to, first of all, I wanted to base once the stock makes the high type flag and then comes in, then it establishes a trading range where you want to buy it. You want to buy the stock, but you want to make sure it gets tight. Is you buy the stock taking out the pivot of the top right there. So your buy point, you'd put a buy stop at 64.10 on it. But this is a little bit jaggy and irregular. That's not as uniform as what you want to see. It's too, you don't want it to come in. See that came in a little bit too much. That came in, 25% from the top, but that's what it was to the 10-day. And, then it was, it's, highly erratic. It's highly volatile, highly erratic, but your buy point would be 64. There it failed. Then it tightened up a little bit. So it's tightening up a little bit. Then it tried to go again. And then, of course, you got stopped out again. And then, but that's the execution. But you don't have to take, a lot of these high tight flags, they don't work in a market environment such as now.
Yeah, because if you take a look at it in the weekly, it's just like it really shows the flag. If you go, you see that there, it's just like, wow.
So the move, it's it's just whippy. It's just, it's like a bucking bronco.
Oh, I totally agree. Because that's the reason why I just asked, is I was just wondering how you would trade. It would be better to trade off the 21, because it looks like the 21 and the 50 are going to be crossing.
Yeah, look at this one here. See, look at this one. See how much better this looks than that one. See it, you hit your top, then you came up here to 45.67. Now you did get stopped out of it right there, but this is more sideways action. This looks.
What's the ticket symbol to that one?
This is PCVX. But that's better. It's just, you got some violations. The violation was it broke out, squatted, came back in, and then it came back in through the 21-day, so forth. So, but this, this one looks better. It's what your eye is looking for. This is just up, down, down, up. It's you can't seem to go.
All right. Thanks for sharing.
You're welcome. I know Mark Ritchie loves those, but and again, Charlie M brought us one earlier. That's a $5 one that looks great, but it doesn't meet my criteria anyway, but the setup's there.
I feel like high type flags are so hard in a bear market to play.
They are, Joseph. But bio names. Let me see. I've got 46 named biotech names with the relative strength of 99. I think. By the way, guys, just as a bit of information, I would, it doesn't matter if if you've got another job and you're trading the market on the side, but what you should have is you should have a notebook where you write your thoughts, write all of these stocks down. I do it every single day, and I've been doing it for 30 years. And you can also go back and refer to that. And I just have a spiral notebook. And, this is how you keep up with everything. I find it easier. Sometimes I put them in, I put them in a buy list on MarketSmith, but the ones that I really want to buy, I write them actually in the notebook, and put the price that you would buy it at if that happens, either on the pullback or a buy stop breaking out. And I think that's an effective tool to help you improve your results. It certainly has helped me over the years.
Hey, Roy. Go ahead, Brad.
Oh, I'm sorry. My process is that I jot my ideal buy price with the stop and first target, and then I actually put it right on the MarketSmith screen, because you can put notes right on the MarketSmith screen with the date on it and everything.
Really? So I haven't annotated my screen. I need to take a look at that. Would you would you give me an example?
Sure. If you open that the far left tab there.
Yes.
Okay. Go to notes. Click on that, and then if you look at the bottom, you'll see the little tiny squares at the bottom there.
Yes.
See the cone? Yeah. I go to the arc. You were there, down a little bit, over, just next one over, the other way. Yeah.
This way.
The third one from the top.
That one.
Yep. Arc. Boom. Click on that, and then now you can just go right to where your point. You create a little arc, and it just where you want to enter.
Okay. Let me.
Yeah. And then okay, now you can just now leave that. Now you go to the T. To go back to it, go to the T. Click on that, and now you can create a text. So you can go back to the thing and just create your own little text box. Click on that. Yeah, there you go. Now spread it open, like you can. Yeah, you might have to. Yeah.
I'll come back to it. I definitely see the point.
Yeah, there you go. So yeah, and then you can do your text right inside.
Oh yeah.
Yeah. And that'll stay on there, and you can put the date on there if you choose, or all your different information. So that so now when you go through your stocks, that'll be on there all the time for you, just to help you remind you.
Yeah, that's really useful. Yeah. Thank you so much for that.
Yeah, no problem. And then you put the alert in there as well. Obviously, to do that.
Yeah. Alerts. And I do find this useful too. Sometimes I like to draw the trend line instead of just having the price there many
Right.
times. Sometimes though, for whatever reason, I can't get the dotted line on, I can't draw the trend line. MarketSmith doesn't allow me to. I don't know if it's too narrow, too small of a time frame, but I use these quite often too. So target T8, I talked about that. So I had a trend line breakout there. Celsius, a price, HALO line. Yeah. So I find this very useful too. Particularly as you're working during the day or.
Absolutely. Yeah, that goes right to your phone. It's fantastic, actually.
Yeah. Yep.
Roy, if you go back to Moderna, it had the 10-300 and it looks like it's breaking out of stage 1 base.
Yes. Yeah.
RS96, even though it's down, I guess, from, I don't know what it's high from, but if it takes out, what was the high today? I think it's 208 or something. Basically, my question is, would you buy that through the wick tomorrow if it goes out, it takes out that high, even though it's I guess down a lot from its highs, since it's a stage 1 base? Would you consider that?
I think I might. I've been trapped in a few of these before, and I'll come back to Moderna. But there was news on maybe an Alzheimer's drug for Biogen, and that's how think about this. So watch to see how it trades. But if it follows through and takes out the high, that's going to be very bullish. See, where Biogen didn't take out the high, but it came into the 10-day.
Yeah.
And that's not ideal, but if it takes out the low, just from experience, if it takes out the low of the breakout day, more than likely just wait. If it takes out the low of the breakout day where we had the tremendous volume, then you wait, you have it on your screen, and you can take a chance and buy the 10-day. You can buy the 10-day. You can see here buying the 10-day, and I didn't buy it because it was just.
You got someone around you who's old? I'm old.
Yeah, so it was. I didn't buy the 10-day because it did the same thing a year ago. But let's go back to Moderna, MR. I mean, I think this could be the launch phase, the breakout phase, the beginning of a major run. I mean, it's not typically what I would normally do, but this would be consistent with buying a stage 2 breakout on volume. Ideally, it gets tight, doesn't take out the low, but it gets tight for a couple of days, and then you buy it.
See, this is what I would love to see with some of those new IPOs, like you showed 4 and that stuff. I would love for us to get this type of action, like a breakout of the stage 1, 10-300, and then you can buy the follow through or whatever. But
and so let me see. So they're the move up, then they rode it over a little. If it'll come into this 190 area and then bottom and hold and then turn back up. You could, you don't want it to take out the low, but if it, depending on what the market does, like on the opening, and then you can have Powell. But if it takes out, I think this would be a plausible, effective buy if it's so strong that it takes that out.
Yeah.
So
that's what I was thinking too.
Huh?
I said that's what I was thinking too, and or I was thinking if it got back through 200, but I think maybe that's a little too risky still. I don't know. I wait for it just to get out of the wick. I don't know. But
It's Joseph, it's all an educated guess. So it's showing up 296 after market.
yeah.
But if it takes the high out, I mean, there's some tremendous institutional interest right there. And this is, you got a bunch of people, in Moderna. But there was some hype too. The CEO was on TV saying that they're going to spend as much time on cancer as they did with the coronavirus. So I don't know how much of that hype is in the stock.
Yeah, I guess it would be just like a pure technical play because like the fundamentals
It is, yeah,
are down.
pure technical. Yeah, pure
Yeah.
technical, because you don't know what's going to happen with the fundamentals. But if it's definitely for a trade,
Yeah,
it's definitely it's definitely tradable. If it'll hold.
If you go to 10 minutes, looks like there's a periodic program buy every 20-30 minutes. Huge spikes.
For who? For what was that?
Moderna.
Oh, Moderna.
If you go to 10 minutes, you can see that there is a consistent throughout the day program buy.
See, this is I got shaken out of this one on day 2. Right there, great action, and it opened. It gapped down the next morning, and I had my stop right there below the prior day's low.
So you bought on the first gap up day, the break, I guess the breakout, the first day.
I did. And I had a stop in, and I was profitable. I was up, so it looks like I was up in the stock, maybe 10 points.
Yeah.
And I put a stop in, good till canceled, like below that level. That's why many times it doesn't pay to put in stops and keep them there, because the computers see it, the algorithms see it.
Yeah.
And then, I mean, that's me getting
They
stopped.
just
out.
come for you, yeah. Yeah.
Like, I was so frustrated because I had a big position. I had a, I don't know. I could have had 500 to 1,000 shares of it, and I had a profit that went to a loss and I just gave it to them. Like, but that was good action then, and then it rolled over. But you want, if it would have held that low, then you could have, then you, as it moves up, then you move your stop up, and then you're guaranteed a profit. But sometimes that those stops work against you when everybody can see them. It happens all the time. That's why I try not to put them in there. But when you don't have them in there, then they go through the stop, and then the stock goes down another 5%. But there's just no way to win sometimes. It's funny, guys. Also, take a look at this, and then we'll call it a night. But see, this is what I thought. The biggest stocks that were showing up were Lantheus. They have a great medical imaging agent that's a game changer for prostate cancer, and the stock had triple-digit numbers. Look at the numbers: triple-digit numbers, triple-digit earnings and revenues, and look at the performance of the stock. So this is one that this was a big position of ours. I mean, a full position, and look how it just came unraveled technically. So this was up here. It had a 99 relative strength. That's what happened with the Lantheus. So you can't get so caught up with these stocks. Look at what happened with Shockwave. Same kind of thing. Triple digit revenues, and either the stock's not ready, or the market, or both. But that's why you can't ride these stocks down, to the 200-day. You've got to take your you got to take your 5 to 10% loss when you can, so you don't ride it down, 35% or more. And so Shockwave failed, Lantheus, and then Celsius also came in, but now it's come back up. So those, had great.
I bought
numbers.
this. I bought this stock the same day you got like it reversed. I was watching it and it undercut the 50, went above it, and I bought it through the 21 EMA. I'm like, if it gets to the 21 EMA, I'm gonna give this a shot, and I'll put my stop at the 50-day.
So
So I bought it. I bought it there, and then I sold it. I think at like I held it to like 105, and then it was down those 2 days.
Yeah.
And I don't know why this year has been such a hit and run market. I was like, I'm just gonna take my gain, even though there was nothing wrong with the stock. It didn't even hit the 10-day, and I sold it. It was just, and then now it's rallying more. I'm like, oh my gosh.
That is, yeah, I've done that occasionally.
Yeah.
Yeah, I do. I make all kinds of mistakes.
I bought that same day, actually, Joseph. I'm sitting in it, not a big position, but I'm just gonna see what happens with it.
Yeah.
Well, thank you for buying mine, guys. Appreciate that.
Well, you bought it actually because I had it on my watch list, but I wasn't really paying attention. I was focusing on other names, but you bought it it was super tight that day, or I think you bought it the day prior, right? It was
Oh, yeah,
super,
no, I bought it. Yeah, I bought it the day before, I think.
yeah, and it was super tight. That looked like a perfect buy. You're like, oh,
Yeah.
It's super tight, it's ready to go. And then
It does look good.
I mean,
this is what, guys, this is the environment that we're in. We just got kicked out of Shoals, and this is it's a solar play. Earnings are gonna be up 106%. And there's the day that that got our attention, and we bought this stock. We took a position on the stock, maybe, I'm guessing, maybe the next day, right in there, and it pulled back perfectly. We were going to double up on it. Came down to the 10-day, reversed up, and then they announced a secondary right there. And so we had, so the stock was down, what's that? Stock was down. I mean, it looked perfect, and then the stock gaps down on the secondary.
and the CEO left.
And the CEO left. So you don't know what so right there, that's from, I'm trying to get
And now it's back above the 10 and 21 days. So that's kind of wow.
But that's what happens.
I know me and you were talking about this stock a lot too. And it's freaking.
Yeah.
Oh
So that's what happens. That's what happens in the market, so.
Yeah.
Oh, it's right click, track price. That's what I want. Yeah, that's what I was trying to get. But let me see, it was down. Yeah, look at this. So so the stocks, and we had a 2% position in it, and then the stock gaps down. We bought it perfectly right. Not, maybe down just a hair, and then the CEO left and they float a secondary, and it's down 20%. And we sold it. And there's just nothing. It's setting up great, and you just don't know what the implication of something like that is going to be.
Yeah.
And particularly when you hear the CEO is leaving for either health reasons, which is, I think Sam Bankman-Fried left because of health reasons, right? Or personal reasons, There's, you just don't know the real. Maybe the news will come back out later, and it'll be, negatively viewed. Guys, I think I'm gonna call it a night tonight. I'll send this. I'll have some comments to try to get comments out tomorrow after the Fed meets.
Roy, would you mind sharing just the screener criteria? The ones that you had about 70, 80 stocks or so. What is the screener criteria?
For the screener criteria for, I have many different screens.
Oh no, the specific one was the one that you ran through the 90 stocks or so.
That was my just watch list. I ran that stock with the relative strength list. I've had everything in I had 100 names on my watch list. That's what I'd moved them over to my watch list. Does that answer your question?
Yeah.
Okay.
Thank you.
You're welcome.
Yes, Roy, thank you for everything. Thanks, everybody. It was a great night. Thank you.
Guys, good trading. Hang in there. It's going to get better. I'm telling you, it's going to be the further this runs, the closer we get for this market to turn, and it's going to be epic. We just have to get in there, survive, trade small. And again, we're only 10% invested. That's the source of our commitment, but don't give up, and you have to put your pilot positions on. And when they finally work, you'll know that the market environment now can get conducive, and you can ramp up your progressive exposure then. So guys, have a happy holidays. Merry Christmas to everybody. And thanks for making our year great. We really appreciate you tuning in and listening and sharing what we have to say. Good trading, guys. Good luck.
Thanks.
Take care.
Thanks,
Thanks,
guys.
Roy.
Take care.
Thank you, Roy.
Happy holidays.
Thank you, guys.